shortages we've seen over the past 2 years, but also the severity that we're seeing even in 2018, 2019, I think it does set a higher bar for businesses laying off workers even as they see output decline. But I think it's still too early to tell to what extent we'll see that. You're maybe seeing some hints of it in terms of like the average weekly hours numbers, particularly in sectors like manufacturing and transportation, which have seen their work week drop below where it was prior to the past downturn. And so I think you're seeing hints of it, but it's really more of a time will tell. And we really, I think, need to see that more persistent drop in output to get a sense of to what degree businesses are holding on to workers. We see some degree of labor hoarding in every downturn, but ultimately, usually midway through the cycle, push comes to shove, you do see those layoffs begin to mount and that hoarding go into reverse. So I think we have to be cautious in how much it can insulate that next downturn.
Morgan Stanley's gone as far as saying a soft landing for the US economy is likely, and the resilient labour market is central to their narrative. Sarah, do you have a base case on the landing, whatever that might be, in the next few quarters, the next few years?
Yeah, so I'd say we're still pretty cautious in terms of whether the Fed can pull off this soft landing, which in our view means getting inflation down without a recession. So we're still expecting a mild recession in the first half of next year. As ultimately, I think it will take a pretty meaningful drop back in demand, I think, to get inflation back in the bottle and keep it there for good. So I think there's certainly some disinflationary momentum building, but in terms of getting inflation all the way back to 2% and essentially sticking that landing, I think we are going to have to see, I think, some weakening in overall demand that's associated with the recession.
Sarah, you've led the debate on this. You've done a great job. John's mentioned it a number of times of getting out front on the stickiness, the ability to get from 4% down to 2%. There's a new trend here. I'm going to give credit to Jim Bianco, folks in Chicago, who's suggesting that not only do we go down to a Sarah House level of 3%, but we turn around and actually we could see an increase in inflation out there. Is that in the realm of possibility?
I think given that we've been looking at inflation running 2x the Fed's target for essentially 2 years now, I think given that possibility for inflation pressures to become more entrenched, for that price setting behavior to be different now than it was prior to this episode, I think it certainly opens the possibility of that risk. I think we continue to see some deceleration as we move through 2024 and I think even further into 2025, but I think that's reflective of the risk that this is not going to be an easy or short battle. There's still a long way to go in terms of bringing inflation back down to the Fed's target, and remains to be seen how much resolve the Fed ultimately has.
Beneath the headline data, okay, what is the data that matters today at 8:30 beneath the headline data? What will you look for?
So I think the labor force participation rate and what's going on with labor supply is going to be hugely important. So this is probably the most important element to the Fed pulling off that soft landing. It's being able to get that labor supply, reduce those wage pressures and that inflationary pressure coming from the labor market, but still getting people employed and having money to turn around and spend. So that's going to be one number that I'm hugely interested in. And of course, just what we're seeing in terms of the average hourly wages, given that inflation is still the foremost concern among the Fed and how that's affecting the inflation picture.
Can we finish on the number everybody was obsessed with yesterday, the ADP report, and the close to 500,000 jobs added? Sarah, I'm sure you took so many calls from clients about that yesterday. What did you tell them?
I told them that since the ADP's redone their methodology, it's undershot the NFP number 7 of the past 10 months by an average of 75,000, and so we're due for an overshoot in ADP. So we're expecting an NFP gain of 260. So notably weaker than what we saw with ADP, but still definitely a robust number for hiring.
So not looking for 500K on payrolls later, right?
Not quite, but still a very strong number.
Sarah House of Wells Fargo. Sarah, thank you. On the latest on a jobs report, that jobs report coming out a little bit later this morning. For those of you interested in some of the estimates, the big estimates on the big banks, from the big banks on Wall Street.
Have they changed much recently?
Here they are. Morgan Stanley, Adam Zentner is going to join us later, 270. We just caught up with Sarah House of Wells Fargo, 260. Goldman, Jan Hatzius, 250. Mike Gapen over at Bank of America, 250. Ferroli, JP Morgan, 200. Citi's Andrew Hollenhorst. This is interesting. Bottom of the pile, 170, but still thinks we get 25 basis points from the Fed later this month and 25 again in September.
The standard error here is a big deal. This is a math thing you flunk on statistics exam. It's 1 over the square root of n, and n here is 150 million. So it's 1 over the square root of 150 million, which means, you know, it's like the width of the Formula One race in Barcelona. You know, it's like way too wide. It's boring.
You upset
It's
with
like-
that track?
Yeah, I'm very upset
You don't
with
seem
Spain.
happy with it.
Spain. I'm upset at the cob that I had just now. The sausage
The
cob
bacon
was
roll.
wonderful. But anyways, the error here at 8:30 I think is underplayed. McKee knows this stuff cold. Can I bring up somebody that I saw in our famous food court? I sit in the food court every morning at 10:05. You know, sort of decompress.
I
find
passed you there, yeah.
It's like yoga. I find my inner self there.
Sure, I do the same thing.
You know, I do it with 2 bags of Cheez-Its. And the answer is Tim Ash comes up to me with Blue Bay Asset Management.
He's
Tim
great.
Ash is like one of my heroes. He's like really, really good. He's got the chart of the day. On radio, all you need to know is it does look like an Elon Musk moonshot. It's all there is to it. It is the generic 2-year United Kingdom bond. It doesn't look like the American bond. It's straight up in the vicinity of 6%, 5.5% around it. Out, John. I mean, what's the level of tension here of do something from a Governor Bailey who said, look, we're not going to declare victory. They're miles from declaring victory right now, aren't they?
Well, when you say do something, what do you mean? Do you think this is a problem right now, or is this part of the solution?
Tim Ash says they need an anti-crisis program. That's where he is. They need to do something in the United
On
Kingdom
the fiscal
right now.
side or on the monetary policy side?
I don't read the reports. I just look at the headlines.
Well, I think we should go through the levels. I've compared and contrasted where we are now compared to where we were at the end of September. At the end of September, you've got Liz Truss in number 10 Downing Street trying to do some pro-growth stuff, some tax cuts, and everyone going, you're crazy, what are you doing? And yields are spiking to 470. We've got this financial instability. Bank of England's in a corner, has to start doing things with bond buying again in the gilt market. And here we are. We have taken out those levels and some. At the end of September, we were at 470, something like that at the highs. And right now, Tom, we're looking at 550. And back then, sterling was on its knees, 103.50. Sterling's having a little look at 130. This moment
With a
right
buoyant
now,
GDP.
this moment now in the UK is very different to the moment we were in back in September. We just don't have that financial instability. Maybe you think that will come, but at the moment it's absent. And you don't have that policy risk on the fiscal side that was very evident, very apparent in September. You don't have that now.
The harder, and I think Christian Horner would say this too, the economist Christian Horner, he would say, what are we upset about? The UK has a buoyant economy, it appears, way away from recession.
It's surprised to the upside, to be precise.
The United States has a buoyant economy away from recession. These are good things, and so rates elevate higher. I mean, that's what they do.
A double-digit food inflation, not a good thing. And these are the issues that people have got. Tom, if you're a saver, and a great conversation with someone about this yesterday, and I'll be talking about it later with them too. If you're a saver right now, you have a lower marginal propensity to spend, so you're getting higher interest rates. Great, Tom, fantastic. But if you're a debtor right now and you're struggling, and you've got to refinance that mortgage because you don't own that house outright, and you've got to do that in the next 12 months, these are really tough times. And this speaks to the idea, Tom, that for one person in America, things are great. Got high interest rates on a lot of cash. Maybe they locked in a 30-year mortgage at nothing. Maybe they own their home outright. For the debtors of this world, Tom, they're really struggling.
You're talking my book. You know that I have trouble with aggregated macroeconomics, and I understand institutional authorities have a responsibility to do that. But off the pandemic, this is wildly disaggregated. I mean, you and I are looking at Austin F1, and frankly, you know, Red O'Keefer of the Amex said, we just can't do that. You got to go to something cheaper in Europe, and, you know, we'll have to do that.
Alarian's coming up later, and...
You just completely ignored me there.
I know, as you often do to me. Mohammed's coming up later, and he thinks there's an over-focus on the demand side and doing things with monetary policy and not enough focus on the supply side.
Do you think Mohammed's going to Silverstone?
I don't think so. I mean, we can ask him. We can ask him.
He's got to go with Aston Martin.
Can I just say, I love that you're into F1 now. I love this.
I'm loving it.
I love that Christian Horner's coming up with Red Bull in about 3 minutes, and I love that you're in a position where you actually want to lead that conversation. I'm all wound up. I want to talk to him, folks. For those of you that don't know this racket, think of the guy with the Los Angeles Angels, Ohtani. The guy driving for Christian Horner, my amateur take is he's like Ohtani. This guy starts with a V. What's his name? Max Verstappen.
Verstappen is just, it's odd how extraordinary he is.
You have drivers like that now and then. Max is just...
Was Schumacher like that?
Sure. Yeah, just on the edge, willing to take that car to a place where other people aren't. It's not just about the car, it's about the person in it. I think we like to overplay the dominance of the car, and Red Bull Racing have done a phenomenal job over the last few years.
Yeah, they've done okay.
the guy driving that car, Max Verstappen, he's willing to push that car in a way that other people aren't.
We're going to do this. It's Jobs Day. We're going to digress in the summer here. We're trying to do that. English football. I don't understand the money of English football. The gazillions being spent. I just don't understand who's getting.
Well, speaking of dominance in world football right now, English Premier League.
Maria Tadeo, we had to medicate her yesterday. Something about Real Madrid.
What did she say?
They signed somebody at Real Madrid, and
She's
Maria
not happy
went
about
mental.
it.
I mean,
we haven't spoken to Maria for a long time.
I know.
We've got to sort that out.
It's really hard to get to her. Her entourage, it's just brutal. It's the worst.
Up next, going into race weekend in Silverstone in the UK, Christian Horner of Red Bull Racing on Bloomberg Surveillance.
For the first, call it 18 years at Chipotle, this was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1.
Right.
So it's ready right when you pull up your car.
How do you manage these kind of two different staffing needs, right?
Yes.
And making sure you have the right amount of people
Yes.
at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple of people, our average restaurant now does about over $1 million per restaurant in digital sales.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. How has that shaped your strategy for the bank? Is this a new normal? Is this like a catalyst? Do you think we're in a new phase for dividend policy overall? That's a great question. I'm Francine Lacroix, and this is The Pulse, every weekday at 9 a.m. only on Bloomberg.
On the David Rubenstein Show, Peer-to-Peer Conversations, I uncover the untold stories of the world's most successful leaders. Watch Wednesdays on Bloomberg Television.
Inflation itself is getting close to bottoming this cycle. We think it's going to be very difficult for the Fed to get inflation below 3%.
Inflation rate bottoms at 3 and starts drifting higher. The Fed's going to find this unacceptable. And that 2 rate hikes that we have priced in for the rest of the year will happen, if not 3.
Even if the Fed does sort of get rates up to say 5.5% or even 6% and keep them there, unless you think inflation is also going back up again, then that policy will become just even more and more restrictive, and they're going to have to unwind those rate hikes very quickly. Otherwise, they will collapse the economy.
What a range of views there. Tom Tsouras of Strategas, Jim Bianco of Bianco Research, Don Constant of Mizuho Americas, setting the stage for payrolls coming out in about 1 hour and 43 minutes time. Looking for something close to 230,000 in our survey here at Bloomberg. Yesterday, that number, before we got the ADP report, was something close to 225. That's crept a little bit higher. We get this so-called whisper number. Let's talk about that whisper number now with Mike McKee of Bloomberg. Joins around the table. Mike, that number just around the corner, the whisper number, talk to me about it. It's creeping higher.
Well, it's not creeping higher. It's shooting higher. Went up to 275 from about 260 yesterday because people saw the ADP report, and it's a bit of a herd mentality. However, it has been sort of an effective strategy to bet on a higher number for the last 14 months because jobs have come in higher than the Bloomberg consensus for 14 months in a row.
Are they quality jobs? This call brought up the dining room table last night. Are they quality jobs, or are we just doing, waitresses, may I help you jobs?
Well, if you look at the ADP report yesterday, it was mostly waitresses, may I help you jobs. However, maybe the definition changes a little bit because we've seen a significant increase in pay for people at the lower levels, and on a percentage basis higher than for people who have so-called high-skilled jobs.
In the zeitgeist right now is this new phrase. I'd love your response, Mike, with decades of experience. Rich, I can't even pronounce it. Rich session. where it's the upper quintiles of people that are feeling job angst. Do you buy it?
Well, yes, in a certain sense, because a lot of where the layoffs are happening have been at tech companies and finance companies who are very cyclical. They staff up when the economy is starting to grow quickly, and then they quickly get rid of people when business falls off. However, we're talking people who aren't going to be suffering as much as the people at the lower end, and so it's a little harder to discern an overall impact on the economy.
I look at wages. A lot of the economists are saying they're going right beyond non-farm payrolls and the rest of it. Explain how Mike McKee sees our wage increases and our inflation agony right now. How do you sort that out at 8:31?
Well, there are a lot of different wage measures. Today we get average hourly earnings, and what's happened is we're starting to see average hourly earnings meet or exceed the inflation level. For a long time, workers have been losing ground because the inflation rate was higher than what they were getting in additional cash. Now we're seeing wages rise. 4.3% is 4.2% is the forecast for today, average hourly earnings, and inflation's running at about. Well, we're expecting next week to see it in the threes.
Mike McKee, thank you so much. We really look forward to 8:30 this morning. He does it better than anyone out there. Alex Kalonakis for Autosport, John, and for the New York Times says from Lewis Hamilton, he's with the evil Mercedes team. And Sir Lewis?
It is Sir Lewis.
It's Sir Lewis. Sir Lewis says it has the best layout for our American audience. And I grew up in the fumes of Watkins Glen. Explain to us what Silverstone means and go to Christian Horner here.
We can do that right now. We can catch up with Christian Horner, the team principal for Red Bull Racing. Christian, wonderful to catch up with you, sir, going into race weekend in Silverstone. Can we start there, as my colleague Tom pointed out? Just how special is this race, this circuit, for you and the team?
Well, look, it's one of the best circuits on the tour. It's fast, it's demanding, it sorts the men out from the boys. It's a big challenge, and it's old school. I mean, this track goes back to just after the Second World War, so an old airfield with a perimeter road converted into a racing circuit that has developed over the years, but it's one of the big tests for the drivers and the teams.
Max was absolutely dominant last weekend. There was this amazing moment at the end of the race with a couple of laps to go. He came in for a pit stop just to get the quickest lap. Christian, can you describe the guy that you're working with every single day? How special is Max Verstappen?
Well, I think what we're witnessing at the moment is a sportsman that's just really at the top of his game, and he's a joy to work with, and he continues to surprise us with just the levels that he's reaching, and the height that he's hitting. So as I say, nothing is. He continues to surprise us at the moment, but he's in the form of his life, and I think there's more to come.
Christian, I think Americans are fascinated by this. I look at the wonderful coverage Sky Sports is doing, and basically they forget about Verstappen 5 minutes into the race to look at all the Netflixy sub races and all that baloney. We have in America a guy for the Los Angeles Angels in baseball named Ohtani, who's once in a generation. Is Verstappen like that?
I think, look, we're in a halcyon period of Formula One. We've got Lewis Hamilton, the most successful driver of all time out there. We've got Fernando Alonso that's doing it for the old guys. And, we've got this emergence of Max Verstappen. And I think only in time will history judge just how good he is. But what we're seeing at the moment is certainly something pretty special, particularly with the results that he's ratcheting up.
Christian, talk to me about how, from a manager's perspective, you maintain harmony within the team. When he took that point for the quickest lap last weekend, that was taken away from Checo, his teammate within Red Bull. Christian, can you tell me as a manager how you're maintaining the harmony when you have to provide the resources for someone as dominant as Max and maintain the confidence of his teammate?
Well, I think he's just dealing with openness and honesty, and I think, look, Max deserved or earned himself the opportunity to have a go at that fastest lap. He created a pit stop for himself. He was going to have a go at it on old tires, and for us it was actually less risk to put him on a set of newer tires and take the pit stop. So he earned himself that right, and I think the relationship between the two guys is strong, and the most important thing is that they talk to each other. They communicate. When there's an issue, they talk about it. We get it on the table, and and get it addressed.
Can we expect Checo to be racing for Red Bull next year then, Christian?
Yeah, he's got a contract. He's with us till the end of 24. So, and we're happy, irrelevant of the contract. We're happy with the overall performance of him. He's had some difficult Saturdays recently, but his racing's been great, and hopefully the confidence from that podium in Austria is going to put him back on the pace here on Saturday.
Let's talk about someone else on the grid who's unhappy. Lewis Hamilton, unhappy with the dominance of Red Bull. Unsurprisingly, Christian, he's had some recommendations on what they can do about that. Maybe we can set a time limit for when we start to plan for next year's race car. Christian, what's your response to people who are fed up with the dominance of your team?
Well, look, it's flattering in many respects. The sport goes in cycles. I mean, Mercedes, how many years did they dominate and nobody got anywhere near seeing them for about 7 years? So, look, we're performing at an incredibly high level. The team is doing its job. And the others, will be putting a target on us and they'll be trying to catch. And I think with stability of the rules, that the field is going to converge. It's only a matter of time. So, I think trying to get everybody to start to design their car at, a start date would just be impossible to manage and police.
Yeah. Christian, our producer, the guy that tells us what to do every day, grew up in Western Australia. So he says, we're not doing the interview if we don't talk about your third driver, Daniel Ricciardo. I think that people looking at Daniel Ricciardo in America are saying, what does this guy do? Do you want to retain a third driver like Daniel Ricciardo, or is it a good feeling for Red Bull if he goes off to someone else, as is rumored?
Well, look, I gave him that chance because I thought Formula One still needed Daniel, and I think that he's still got more to give. We know how talented he is. He just needs to rediscover his form and his mojo, which he seems to be doing, certainly in the virtual world, and he's testing our car in the real world on Tuesday and Wednesday of next week, and we'll start to see where he's at as in relation to the race drivers. So it'd be great to see Daniel back on the grid next year, even if it's not in a Red Bull car.
Christian, a sensitive issue which we see in the danger of Formula One and all the safety efforts that are made. There have been 2 really difficult deaths in Formula One, including a tragedy recently, I believe, in Belgium. What do you do day to day, tick by tick, to make the sport safer? What's the next thing to make it safer?
Well, look, I think the FIA do a great job in terms of the safety of these cars. It's just, compared to where they were just even a few years ago. If you look at Romain Grosjean's accident in Bahrain, I think that a human could actually survive that is beyond belief. But, you can always do more, and the FIA are constantly pushing us, with the cars, but also now the circuits. I think there's circuits that we need to look at because we can only take the cars so far. I think there's still more that we can do as a collective with the FIA on certain circuits.
There seemed to be, I was baffled last week watching every minute of it and really, what your team did. And I look at, I guess it's called the stewards, where the track isn't working out and people are going off the track and there's 1,200 violations. We don't see that in American sport. Are we going to see that again at Silverstone, where the quality of the driving is so good that the track doesn't fit the excellence of the drivers?
Yeah, hopefully not. I think that was something that needs to be addressed moving forward. I think the problem is it was 2 corners that are inviting the drivers to go out there, and of course they can't see the lines. They're driving by feel, and I think that if there was a piece of a gravel strip there or something like that, they wouldn't go near it. If there was a wall there, they certainly wouldn't go near it. So I think that there's things that can be done to to improve the situation. Hopefully it won't be an issue here, but you've got to stay in the lines.
I do want to finish on safety and the track. Christian, there are some worries that maybe we have some protests. The climate change protesters that we've seen protest various sports in the UK over the last few years. Are you concerned about that over the weekend? What have your conversations been with the FIA over the last couple of days and your own drivers going into the weekend with regards to that?
Well, look, it is a big concern because, look, you run on a cricket pitch or a tennis court, there's only a bat and a ball out there. You run on a Formula One track, there's 20 cars going around at speeds of close to 200 miles an hour. And from a safety point of view, it is unimaginable or unthinkable that people would put themselves into, and the drivers at such risk. So I really hope that nobody does anything stupid this weekend. Formula One is taking sustainability and is pushing that message and driving with fully sustainable fuels that we have coming for 2026. We're doing more than any other industry to champion that, and I'd be really disappointed to see somebody try and upset what is going to be probably one of the biggest sporting events on the British calendar this year.
Christian, I've loved our conversations. We've loved our conversations. Let's continue them. Good luck for the race weekend. As a Ferrari fan, you know that I don't quite mean that, but good luck.
Oh, I do. Good luck. I mean it this weekend.
Christian
Red
Horner
Bull.
of Red Bull Racing. It's been absolutely dominant.
How do you say that's rude?
Absolutely dominant, Red Bull. Every single race has been phenomenal to see. It's not just about the team, it's about the driver. Max has been at another level, TK, really has.
It's like Otani, but on an individual, that hyper-focused, you're the driver basis. The thing I got out of that, folks, as a complete amateur, John Farrow, is how they can't see the track. When they go off the track, they can't see.
Such limited vision.
I was not aware of that.
Looking forward to the conversation we have
there?
coming up for you in just a moment. Mark Cabana of Bank of America. You did better than okay.
Okay, good. I'm
loving your interest in
I was up all
Formula
night,
One.
pulled an all-nighter.
Equity futures slightly softer here, negative 0.1% on the S&P 500. The jobs report just around the corner. The number in our survey, 230,000.
We continue to believe that we're going to see a global economic recession.
We can get a soft landing, fantastic, but a hard landing is very much still on the radar.
We do think that the risk of recession has risen. I do think that the Fed is going to continue hiking rates.
Given this price into the market, it will take a lot to derail a hike.
Our inflation forecast is strong enough on the downside that they don't need to hike again.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
It is Payrolls Friday, live from New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance on TV and radio. Alongside Tom Keene, I'm Jonathan Farrow. Your equity market just a little softer going into that payrolls report, 90 minutes away. In our survey here at Bloomberg, the number we're looking for, 230K. In the previous month, 339,000. That estimate, Tom, just creeping higher after some dominant blowout numbers we saw just yesterday in the ADP report.
Maybe it was going to be a sleepy July Friday. That all ended 72 hours ago, and then with the vengeance with the ADP report yesterday. Chairman Powell is going to be briefed on this by the fancy people at the Fed, John, with a 1.80% real 10-year yield. You got a 10-year nominal yield of 4.06%. I have a print right now of 5% on the 2-year yield. The linkage of bonds into this jobs report is tangible.
2-year, 5%. 10-year, 4%, 4 handle on 10s at the close yesterday, I think, for the first time post-SVB. Had all that banking stress, Tom. Yields dived. We're talking about a credit crunch, a hard landing, and here we are a few months later, not even talking about financial instability when we have these central banking conversations.
This is really well taken, and there was some fancy work. I can't even keep up with it last night, reporting on deposit flows and money market flows. Mark Cabana is going to join us, who's smarter at this than I am, and the answer is...
Smarter than us both.
Yeah, but the answer is, John, is... I don't think that problem's gone away. When I look at where yields are, and I remember the disintermediation of money market funds a zillion years ago, why can't that happen again? I'm watching money market fund flows.
Tom Constant agrees with you over at Mizuho. He thinks it's already started. The process has, Tom, and ultimately we end up with tighter financial conditions, tighter lending standards, and softer growth. Other people are pushing back. The division at the moment, Tom, is just amazing. We spoke to Tom Titsouris Strategas earlier this week. He thinks that inflation expectations for this cycle are bottoming, that they're going to tick higher again, that inflation's sticky.
Well, this
Fed's going to have a real challenge. That's one view. Other people taking completely the other side.
Give me credit for this. I coined it disinflation. That's where Bianco and Tissouris are as well. John, I got to say good morning, everyone worldwide. The reach that we have, we say good morning to Belgium and the Flemish landscape, as they were bedazzled, John, by your knowledge of Mr. Verstappen.
Would you like to share the tweet?
Have you been to Fleming? Is that what it's called?
To Belgium.
Belgium.
I have not been to Belgium.
It's supposed to be gorgeous. It's like,
Max's mum is Belgian, apparently. Father's Dutch. And we all know who Jos Verstappen is because he was a racing car driver.
Yes, we all know that. Mark, help me here.
So a lot of people assume he is Dutch, but also I think that the Belgians are
Dutch is not Belgium. There's a difference.
No, that's the Netherlands, Tom.
Thank you.
Yeah. Okay, let's move on quickly. Mark, we need you to save us in just a moment. Equity futures right now on the S&P softer by not even 0.1%. We're pulling back over the last couple of days, though. Yesterday on the S&P 500, incidentally, biggest one-day loss on the S&P.
Crater.
Going back to late May. In the bond market, we talked about these levels. 2-year, 5%. 10-year, 4%. Yields up again this morning by a couple of basis points. Call it up 3 to 4.0576% on a 10-year. And the euro just short of 109 at the moment, 108.91. Lucky to have Mark Cabana of Bank of America, the head of US rate strategy, with us around the table to make us all sound smarter. Mark, wonderful to see you.
Thanks for having me.
I want to start with a quote from you about the extreme inversion in the yield curve. You think this is not about a hard growth landing. You think it's about a hard inflation landing. Can you talk to me about how you identify that distinction in the bond market right now?
Sure. Yeah, our team has been doing great work along these lines. What we really look at are what inflation expectations are priced to do, and then what real interest rates are expected to do. And what we see is that real interest rates look very, very high at the front end, and that's due to the fact that inflation is expected to decline so rapidly. Look, 2-year break-evens are just a tad over 2%, which is really amazing given how sticky inflation has been. And so when we look at that data, we just think that, well, the reason that the market has been pricing rate cuts from the Fed is because inflation is expected to fall so quickly. Meanwhile, real rates are very elevated. And what we've been recommending is that if investors are worried about a harder economic landing, you want to be long real rates at the front end. But if you're worried that inflation could be more persistent, a problem that we've seen globally, front-end inflation looks way too low to us, and that seems like a good own and a good way to position just a higher and stickier inflation.
I'm still a phrase from Peter Orszag, now holding court at Lazard. Peter codified the modern idea of glide paths. Are all these relationships, these curves, these time series, are they smooth, orderly glide paths, or do you worry about instability, kinks in the curve, or jump condition?
I think you have to worry about those types of jump conditions because when you see such persistence in inflation, when you see such resilience in the economy, you're only in one mode if you're a central banker, which is that, well, we haven't done enough, policy is insufficiently restrictive, we need to do more, and then what that typically leads to is an overshoot. We certainly have seen that with some signs of regional bank stress. We do worry that you could see credit conditions tighten more meaningfully in these types of dynamics as well. And I think you have to worry that you might be too restrictive for too long.
My history of this, whether it's Meltzer or Bernanke, frankly, is overshoots always happen because they're mortal. You know, they just keep going. What's the x-axis look like of an overshoot? Can an overshoot be mollified out one Fed meeting? Is it out 2 quarters? Is an overshoot a 6-month process?
Well, I think that what the Fed is doing is recognizing that they may indeed run the risk of overshooting, and so it makes sense to go slower. And that's one of the reasons why we think the bond market has been effective at taking out some of the cuts that have been expected in late 23 and the first half of 24. Because the data clearly suggests that the Fed needs to continue to tighten. They have every reason in the world to keep going. The payroll report we're going to see in a little while will likely give them further justification to keep tightening. But the fact that they appear to be going slower does seem to be taken in the context of not wanting to overshoot. And if you're a Fed that doesn't hike too far too fast, it runs the risk of you reducing that overshoot. And it also perhaps means that you won't have to take back some of the tightening as quickly.
How much weight should we be putting on labor market data as a policymaker making these kind of decisions?
Well, again, the Fed has 2 key inputs, right? Labor and inflation. And when you see that the labor market is still so out of balance, you've got to take that into consideration. And you know that you're not going to have a good chance of achieving sustainably lower inflation unless the labor market is indeed in better balance. So they've got to take it very seriously, and that's certainly going to be a tailwind that keeps them in hiking mode for a while.
When they say better balance, do they mean higher unemployment?
Yeah, to some extent. I mean, they think that the unemployment rate in the longer run will be around 4%. They know that they're going to need to see either outright job losses or much slower job gains. Powell has told us in the past that about 100,000 NFP per month is his bogey, more or less. And so they really do need to see further declines or further deceleration in the job market in order to convince them that they've got a shot of achieving 2% inflation.
Alan Zentner and Morgan Stanley joining us later. Sarah House of Wells Fargo with us in the previous hour, talking about the prospect of labor hoarding, corporate America holding on to workers. And some of them pointing out that maybe we should be focused on things like the average working week, reduced hours, just evidence of corporations not letting people off but reducing their hours. Is that a dynamic that you and the team at B of A with Mike Gapin, you guys are focused on too?
Absolutely. And one of the things that Mike and team have been talking about is how we've seen a decrease in breadth of the hiring that has been taking place. We're seeing more hiring in what they've referred to as high-touch services, i.e. leisure and hospitality, education, healthcare, the types of work that's more difficult to do remotely. That's where the labor growth really appears to be concentrated. We saw that in ADP yesterday as well. And that really does show that the breadth of hiring has narrowed to some extent. You're no longer adding as many jobs in manufacturing or financial services or elsewhere. And we do think that that is somewhat consistent with labor hoarding, or at least some softening in the labor market, consistent with declines in average hourly, or with declines in the average work week.
Liz and Saunders of Charles Schwab just put out on Twitter a brilliant scatter dot chart. All you got to know, folks, a scatter dot chart looks like, say, shotgun pellets in a piece of paper, and it shows how this year is so out of the norm. It is absolutely bizarre, whatever the relationship of her chart is with real inflation and that. The bottom line is we're living in out of norm space. If we're out of norm, should we be investing normally? How do you take the cabana world and bring it over to, okay, this is what you ought to do?
Yeah, well, so as far as interest rates go, which is our wheelhouse, what we've been recommending to clients is that, look, you've got to stay underweight the front end because the Fed is going to continue to tighten. They are not done yet. But at the same time, you need to be mindful of the fact that it's a bit of an unusual world. We're not exactly sure when exactly the economy is going to peak, and you don't want to miss it. And so as a result of that, you want to be neutral the back end, if not slightly long. That means a flatter curve. And we also believe that if you're going to be long, you want to be long real rates because you want to be expecting that inflation will be more persistent over time and that the Fed may end up accepting a slightly higher level of inflation.
This is really important then. The 10-year real rate is what an amateur like me looks at. I learned that from watching The Real Yield with John Farrow every afternoon. Now,
Not anymore.
The Real Yield with Katie Greifeld.
Watch that instead.
I'm in the surveillance snap usually. I watch it on tape, on digital. But the bottom line is the 10-year inflation-adjusted measurement has gone from 1.5-ish to 1.8-ish. Where's the cabana normal on that key data point?
Yeah, we think it looks high. We think that that's...
You think it's high now?
Yes.
Oh,
we think that's a good own if you are a longer-term investor. We don't expect that that will sustain itself.
It will not go back to 2006, 2.05%, 2%, whatever.
Look, in the near term, you really need to see some type of positioning adjustment or some type of softening in the data to stop rates from rising. And I can't guarantee that the 10-year won't retest 2% real in the very near term. But generally speaking, we think that 10-year real rates at around 1.8% are quite high historically, and we do not expect that they will persist in the longer run. We think that they're a good own for investors.
Final question.
Good
Why don't they just
buy
send at the Federal Reserve? Why don't they just send over on the FOMC when clearly they wanted to? You can see it in a minute. What's that about?
Yeah, you know, I guess that they like to be a part of a consensus-driven organization. It seems like
Is there value in that, Mark?
Look, I think that you need to be comfortable speaking out if you really do disagree. It seems like they've been more comfortable to do that in their subsequent speeches as opposed to doing it when they actually sit around a table. I do think that we are getting to a point in the economic cycle, though, where data has become more divergent, opinions differ, and it certainly wouldn't surprise me if we do see more dissents build over time.
Mark Cabana. I've loved it. Thank you, mate. Thanks for being with us. Mark Cabana there of Bank of America on rate strategy, Federal Reserve, and some of the economic data we get out a little bit later this morning. If you are just tuning into the program, welcome to the program. The S&P 500 right now. Equity futures negative by 0.04%. Coming up very shortly, we'll catch up with Chris Morangi of Gabelli Funds. Looking forward to that. We'll also be speaking to Randy Krosner, the former Fed Governor, Tom, a little bit later in the next hour, going into the payrolls report shortly.
And this is about the theory that's underlying. I'm going to go to Centra with him, and that it's Centra, what I saw were 4 central bankers without a theory. You know, the Bank of Japan guy Ueda was wonderfully articulate as a new member of the chosen 4 major central bankers. But is there an operative theory out there, or is it like Liz Ann Saunders' glorious scatterdot, where we're living a completely outlier 2023?
I'll go back to what Seth Carpenter over at Morgan Stanley discussed, who was there. his reflections on Sintra, just the absence of conversations about financial stability.
Yeah.
When those conversations were so dominant, that debate was just a couple of months ago. And now all of a sudden it's back to where we were pre-SVB. Inflation's too high. These central banks have got to do more. Are we taking our eye off the ball just a little bit again?
I'm reading every article on commercial real estate. I'm not being gloomy about it. I don't want to be doom and gloom, but I just think it's part of it that we don't watch. Yeah, it's got a New York City bias to it. That's my own problem. But nationwide, to monitor commercial real estate, I think, is critical right now.
Number one takeaway?
Part of that.
What is it?
They're coming down. It's irreversible. The cycle, it's not like a 30-year mortgage. The cycle in commercial real estate as an amateur, I'm going to say, is 7 years. So it's like England. It's more acute.
Can I just say that 30-year mortgage at 2-3%?
Every day.
Oh, take
Mark,
me back
can you
in
help
time.
me with this? Every day Farrell brings us up.
Take me back in time.
He's looking in the 60s and
If I
70s.
could just, I want to go back a few years. I want to go to a First Republic branch and just say, give all your money, but in a nice way,
John
not in a
Farrell,
bank
they'd
robbery
probably
kind
do
of way.
that. You're a hitter. I mean, you're on threads.
I'll give you 2-3% over 30 years. Give me all your money. Can you imagine? What a trade.
Yeah.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority.
3 prime ministers, 4 chancellors, an energy crisis, and the soaring cost of living. It's been a hard year for startups, but even in the toughest times, some of the best ideas are born here in the UK. Bloomberg UK's Startups to Watch will profile the brightest companies under 10 years old, with the winners unveiled at the Bloomberg Technology Summit in London in October. Get your entry in by the 7th of August for the chance to have your company profiled and to attend unique networking events. Good luck, and we hope to see you there.
In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally. We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg. The Fed is hoping unemployment will rise, but economists think differently.
We might see unemployment drop back from 3.7 to 3.6.
3.5, 3.7, 3.6. It is an extremely low unemployment rate.
This Friday, the surveillance team brings you the crucial jobs data and expert analysis at terminal speed.
Which movable part matters?
We've had so many upside surprises.
We haven't seen the full impact of tighter monetary policies.
The Fed is going to hang tough. The June Jobs Report, today on Bloomberg Television and Radio.
Remain concerned about whether inflation will return to target in a sustainable and timely way. And I think more restrictive monetary policy will be needed to achieve the FOMC's goals of stable prices and maximum employment.
Laurie Logan there of the Dallas Fed, the president at the Dallas Fed, ready to go again. And maybe again, and who knows, maybe again after that. Going into the payrolls report, which is just coming up shortly, just around the corner later this morning, 1 hour and 13 minutes away. We're looking for 230,000, Tom, according to our Bloomberg survey.
This is one of the benefits here, folks. We do no planning here. John and I have absolutely no clue what's going to happen on the show. We really delegate it out to Amy and the team, as best they can. Qantas is in meetings all day, but other than Qantas, the team is putting it together. And Lori Logan, she comes up to me at Jackson Hole. How you doing? She's newly appointed, Dallas Fed. And I think for our audience into this Jobs Day, we don't talk enough about how different each region is and how different each governor is. And there's a culture that Lori Logan represents in that statement about higher rates, we got to toe the line, versus what we hear from other Fed governors and presidents. It's hugely American, hugely cultural.
She's clearly on the hawkish side of the spectrum right now, looking for tighter monetary policy. Certainly, that speech took on greater importance after the blowout jobs report we got yesterday from ADP. And those comments came shortly after that jobs report. ADP was just a blowout, Tom. I think a lot of people are willing to put that to one side and say...
Yeah, really? You think so?
500K? Yeah, sure. I mean, look at
okay,
how the bond market
500K,
responded.
but they're still going up.
No, absolutely. We're on the same page. We've had a stream of upside surprises in US economic data over the last few weeks, which suggests this Fed does indeed need to do more. There are some people, though, Tom, that take a different view on this, that think that this data and these beats we've seen just reintroduce the risk of the Fed going too far.
And Citigroup with a low number today. I mean, I'm going to call them an outlier number. As I saw earlier, 170,000. The whisper number, we went through this last hour. Let's do it again. We'll do it in the 8 o'clock hour before that 8:30 report. McKee to the rescue, the terminal. For those of you with the Bloomberg terminal, this is one of the reasons why you have a Bloomberg terminal, is weird stuff like this. We have a whisper number.
And the whisper number's getting higher. It's been surging.
Bring it up if you can from 260. That's a ginormous number. I mean, that's nowhere near where Chairman Powell wants it.
No. And this is why it's taking so long for the economy to slow down. Torsten Slock, Apollo, put out a great piece moments ago. I'll share some snippets of it with you. He's put out 5 points. Here's 3. High savings in the household sector. Post-COVID, strong demand for air travel, hotels, restaurants. During the pandemic, high-yield IG corporates extended the maturity of their loans, making them less vulnerable to higher interest rates. Point number 3, and we discussed this 20 minutes ago, US households have 30-year fixed mortgages and are therefore less sensitive to Fed hikes. Higher mortgage rates for home buyers are holding back supply of homes. Just a couple of points there as to why it's taken so long to slow this economy down.
We'll get Torsten on soon. It'll be good. Right now, we're going to digress here. Christopher Morangi joins us. He's co-CIO with Mario Gabelli at Gabelli Funds. I'm going to do an audible here, folks, because I know it's front and center for my colleague Paul Sweeney. Look for us 9 o'clock on radio. We do not have Mohammed El-Arian with us today. And Chris, I'm going to go to the heart of Mario Gabelli's work, which long ago was the media companies. You're expert at this. For our viewers and listeners, we know, we can feel at home the industry's in total chaos. Can the media business, as a generalization, can it find a new profitability?
Morning, Tom. Yeah, well, the short answer is yes. This is a business in transition. It's been in transition for many years. It's not the first time it's gone through transition. Obviously, you've had the move from radio to TV, from broadcast to cable, and now we're going to direct to consumer, and changes in profit pools. On top of that, you've got cyclical headwinds as well, trying to connect this to Jobs Day. And the cyclical has not been good. Advertising's been in a recession for over a year now. Early indications from this year's upfront ad sales are not looking great. Companies are pulling back on some of their marketing spend. So that's an additional issue on top of all the secular changes that have gone on.
I mean, on a people basis, I've got Iger at Disney looking for an extension of his contract out to 90 years old, whatever the gentleman from Ithaca College is going to do. And then I got Zaslav over at Warner Brothers Discovery with a value high debt load proposition. Do you want to go with a blue chip outcome like Disney, or do you want to go with a troubled merger story like Warner Brothers Discovery?
Well, there's a tremendous amount of upside in Warner Brothers. And I would note that one of the attractions there is that 90% of their debt is actually fixed. So you got to look a little deeper. They are highly levered. They're knocking down that debt pretty quickly, but they have locked in pretty attractive interest rates. And I think they're realistic about their prospects. They're beginning to sell content to third parties or resuming selling content to third parties. They don't need to stream it all on their Max app. So I think Zaz has a good vision. Difficult to implement. There'll be more bumps in the road. But again, tremendous upside there versus a $12 stock.
One final question on media. Do you overweight it, or is it a normal part of a Gabelli portfolio?
Well, at the moment, we've de-emphasized the sector a bit as we go through this transition. There, frankly, aren't a lot of media companies to buy, and we'll see, I think, consolidation as this goes on. So there, at some point, maybe under a different FTC, going to be a lot of opportunities in the space.
Chris, what kind of media company do you want to own? Is it a pure media play, pure streaming play? Is it something like the Walt Disney Company with the theme parks attached to it as well? What is it you want to own?
Well, certainly one of the bright spots in media, and one that we have favored for many years before COVID, has been this entertainment, live entertainment and sports concept. They're pretty well-known secular trends, Gen Z, millennials. investing in experiences versus things. And we express that with our ownership of Liberty Braves, which is the public company that owns the Atlanta Braves Baseball Club. Sorry, Tom, as well as MSGS, which owns the Knicks and the Rangers. You go to any of these events, they're packed, people are watching, and they will hold their value no matter what the media backdrop might be.
Chris, it's amazing to see what's been happening with services in America. We know how busy the airports have been over the July 4th holiday. Chris, it's not just the airlines, it's the cruise operators as well. From your perspective, and I guess it's a question that applies to the world of economics, Chris, but for your perspective, how long is this going to last? This pent-up demand from the pandemic that's being splurged right now on vacations.
Yeah, well, I think there's been a lot of concern that it won't last, which has weighed on the parks of Walt Disney and Comcast as well. But, again, this existed prior to COVID, and COVID just added fuel to that fire, fuel to the desire to get out. There really is a true predisposition to spend on these experiences. I don't think that's going to change. There's a lack of supply, and that's benefits the owners.
Chris, one of the hallmarks of Mario Gabelli and what, frankly, Mario Gabelli invented was a value that's growthy. Right now, how do you define growth within a more measured, conservative value proposition?
Yeah, we don't really agree with the index keepers' definitions of growth versus value. Growth is a component of value. It can add or subtract from value depending on the cost of capital and the moats around it. We don't mind. We, in fact, love buying growing companies as long as they are trading at a discount to their intrinsic or private market value. We have avoided some traditional quote-unquote value sectors like banks, we still do, and energy, both of which because they're commoditized industries.
Chris Marangi of Gabelli Funds. Chris, love to catch up. Thank you, sir. On a Payrolls Friday, talking about the media companies, services, TK, and other sectors too. The demand, the pent-up demand for services in this country has just been phenomenal to witness over the last couple of years.
I don't think anybody saw, even the people that were pro-services, pro-airlines, and all that, I don't think they saw it coming.
Cruise operators.
Why is Gabelli different? Gabelli's different because they started as sell-side securities analysts. These are people chiseled. You see Marangi, you don't see this on radio, but over Chris Marangi's left shoulder there were 200, manila envelopes, manila folders rather. Right. Each of those is a company. That's old school. Marangi's old school. That's what happens when you go to Williams. You don't do the computer stuff. You don't do Bloomberg Intelligence. You got a manila folder with stuff in it telling you about your company, and you go and you reach for your company, and it reaffirms what you want. It's old school, Gabelli.
You're reminiscent.
Yeah, it's old school.
Good times.
Yeah, before PDFs, before computers.
10-year, 4%.
Back with a quill.
2-year at about 5%.
Dip the ink in.
Payrolls an hour away. We're just going to keep talking over each other.
Yeah,
okay.
It's the shtick.
Ellen Zettner and Morgan Stanley. That's the shtick. Ellen's up next.
London will stay a financial center. It will stay our EMEA hub. We'll just have a rebalancing onto the continent. And actually, the numbers of who has moved across aren't that big. So it's sort of in the 200 level. And if you think about 15,000 people, that's sort of not that material. And so I do think both will basically continue to grow and continue to be very relevant. What will change, though, and the big thing that's changing, is actually the risk-taking is what's going to move. And so we've historically had risk-taking in the UK. That risk-taking and the assets that go with it, not the people alone, but the assets that go with it, that's the next phase of what we're now moving into. And that will be a material change.
July 11th, Bloomberg is live in Lithuania for the NATO Leaders Summit. Support for Ukraine, expanding partnerships, broad security challenges. We're bringing you news from the meetings and what they mean for the markets.
At the summit, we'll actually make important decisions to address our two main threats, Russia's aggressive actions in our efforts to fight terrorism.
It all starts July 11th. Bloomberg, your global business authority.
Absolute nightmare. We're talking about White Lotus in the commercial break. Can you imagine TK as a hotel guest on vacation? You'd be a nightmare. You would just be, I cannot, I've been in bars with you and your trouble.
I was thrown out of the Hassler in Rome once.
I can believe that. You know? What, because you don't like how the martini was made?
They rolled me down the Spanish Steps right into the fountain.
I can believe that.
Yeah.
Ellen Zender and Morgan Stanley coming up shortly. Don't miss this conversation. Just going into that, I want to give you a snapshot of the price action at the moment. The equity market shaping up as follows. On the S&P futures, just a little bit softer. We're negative here by 0.1%. A couple of days of losses on the S&P 500. Yesterday, incidentally, the biggest one-day loss going back to late May. On the NASDAQ right now, we're negative 0.2%. Softer across the board because of this right here, the bond market. Slice and dice the yield curve, 2-year, 10-year, 30-year, 2-year, looking at 5%, 10-year, looking at 4%. Yields surging off the back of the ADP report yesterday. Blowout number, just to see that close to 500K. It's a head scratcher, isn't it, Tom? You come into a number like that and everyone says the same thing. ADP, don't really care. And then you see 500, chaos. Yields on a 10-year, 4%. I think we closed at 4 yesterday for the first time since the collapse of SVB. And it's been remarkable to me, to you, Tom, to others as well, how quickly we've moved on from the SVB malaise. We stopped talking about it. We're now focused on the Federal Reserve hiking again. And yields are back at levels where they were almost 7 or 8 basis points below now, through them yesterday at the front end, where they were right before the bank started to collapse.
Rounded up 5.01% on the 2-year yield. We could do data checks all day in fixed income, and I'm going to be blunt. I am a believer that fixed income is always out front of equities. It was wonderful to have Ellen Zentner with us a few days ago, really to give us perspective here into July. And as always on Jobs Day, the chief economist from Morgan Stanley joins us this morning. I mean, 270,000 is a big number. I mean, you know,
it is.
No other way to put it.
270,000 over at Morgan Stanley. You've got Citi, Andrew Hollenhorst looking for something close to, I think, 170, wasn't it?
Yeah.
Tom, 170,000 over there. All of that going into the payrolls report. They're looking for an unemployment rate of 3.6%. This is what Ellen and the team has got to say. Net new job gains have come in stronger than expected over the past couple of months, but we look for a deceleration to restart as labour market indicators have shown signs of easing and the effects of seasonal factors, Tom, normalise. Less seasonal fluctuation in hiring should be a drag on June job numbers.
That's the minutia. That's what she's famous for. Ellen Zentner joins us right now on the granularity beneath this jobs report. What's a seasonal job? Are you like, is Morgan Stanley counting lifeguards?
No, we're not counting lifeguards, but you know there are. Look, these months around June, July are difficult and volatile months in jobs data because
June is harder to guess than most months.
Yeah, because you've got you know, uncertain and changing times of when kids are out of school.
Yeah.
You know, you can see it in the jobless claims numbers too. Some fluctuations there around the timing of summer things. When did kids get out and go get jobs? When are teachers out of school? And that sort of thing. So you've always got that uncertainty. I think, John, as you said, that yesterday was a blowout ADP number.
That's nuts.
So even though, you know, we are near the top of Bloomberg forecasters at 270, well above consensus, I think you would have to get a 350 print here to really surprise markets because they're already expecting a very big number. And, you know, the markets are leading the Fed toward that July hike. Probably it would take less than 100,000 reported today for the Fed to second guess themselves, if you will, on raising rates in July.
I saw that note over the last couple of days. You set the bar for the Fed at below 100K payrolls. Was it 0.2% month on month? Is that core inflation next week?
For core CPI,
You get those two things, you don't think the Fed hikes?
Yeah, I think it raises enough doubt that the pause could be more than just one meeting. But you can see how low the bar is for them to go. And so that's why the thresholds, that's expressed in the thresholds being so low at 100K on payrolls, 0.2 on core CPI.
You can feel the committee splintering just a little bit. You can feel it. You can see it in the minutes as well. It's to be expected this far along in the hiking cycle. What camp are you in? I'm sure there's a couple of camps on the FOMC. I'm sure one is the long and variable lags crowd who believe we've done enough, it's in the pipeline, it's going to come through. Others who believe that we just haven't done enough. Which one are you in?
Yeah, so we've done the deep analysis around what could be the lags in monetary policy. We think on business investment, the greatest cumulative impact is in the fourth quarter this year for the consumption in the first quarter. But we have been writing since last year about this soft landing, and it's because the economy has much more cushion to absorb higher interest rates. To me, the complacency that's misplaced is around credit, the changes in lending conditions and credit availability, and that takes a couple of quarters to show up, which would presumably be around the third quarter, and that's something that Chair Powell talked about as well. So I'm in the camp of we're not in the clear yet, and there's a bit too much complacency out there.
We're going to rip up the script here. We do that on Jobs here. I'm going to look at Zentner. I can't pronounce this. Anzoe Togu. I butchered that.
What's this going?
Dujan Heyman. You've got a team of people over there in economics looking at, say, Jim Caron's world and the rest, looking at the bond world. What are the indicators you see in the short-term yield space that give you credit angst?
So commercial and industrial loan growth, right? It's slowed sharply. That is how small businesses fund payrolls. They buy equipment. They build inventories. It has a very good lead to job gains. And so, you know, what did we see in the ADP yesterday? Large corporations are not hiring. We know that. Companies have been saying that. I'm hanging on to my existing workforce, but I'm not hiring. The hiring is coming from small business. That's more difficult to measure and more difficult to get a handle on when that environment changes. And they are most impacted by the changes in credit since March 8th.
Ed Hyman was with us a couple days ago voicing exactly what you're saying. Ed stated with all his decades of experience, he's never been this cautious, this gloomy on the American economy. Do you share not so much the recession call and the hype over that, but just the lethargy here within the system, maybe what the IMF's talking about, just a flatness to where we're heading?
Look, I'm definitely on the optimistic side for the U.S. I think there's a great tendency to underestimate just how much cushion there still is in the economy to withstand a sharp slowdown. And that's why we're calling for, you know, a soft landing and not recession. I think the consumer is still resilient here, but I think we need to take a break. And I think what we're seeing is households outside of the top income groups have taken a break from spending. We just can't see it because those top income groups are out there with insatiable appetite for services. They're the ones going to Italy, John. I went to Greece. You know, like you can't hold me back from consuming my services and travel.
I went to Dwight Reed.
And we are holding up. We're holding up all of the consumer.
You and the team have written recently about the significance of the reduced working week, hours worked. Can you build on that a little bit for us this morning? We talked to Sarah House of Wells Fargo about it too and mentioned your work. How important is that at the moment for you?
Yeah, so hours worked is extremely important because one, it's a direct tie into GDP. It may be one reason why GDP has been running higher than GDI because GDI would pick up more of the cut in hours worked. I mean, it's picked up in GDP too, but we know there's a lot of concern out there that the GDI numbers, gross domestic income, which is running below GDP, is telling us something more about the slowdown in the economy. It's something that the minutes had mentioned as well. It also tells me that our labor hoarding story that we've been telling about companies not letting go of existing workers, and we've been telling this story for a year now, you reduce hours first before you let workers go, and that's how you control your wage bill.
Do you think labour hoarding is compatible, consistent with this idea that inflation can return to 2%?
Yeah, I do.
Can you explain that a little bit more?
I do, because you will, for a time, run payrolls, run your labor in excess of your output, or right in line with your output, right? And so that demand for labor, it's in balance. The demand and supply is more in balance when you're labor hoarding. And so that does put further downward pressure on wages. And look, we're still stuck in the same story, and it's getting boring, it's getting old, it's getting tired. Inflation is high, but coming down. Wages are high, but coming down. Wage growth.
Right.
And so it's just frustrating. That's the frustration of the Fed, expressed in the minutes as well. Things are moving in the right direction, but gosh, we really want it to go faster.
The consumer is resilient. When I met you years ago, you were truly definitive on the pulse of the American consumer. Do you aggregate the American consumer, or is it now so partitioned because of society, technology, the issues that, say, Paul Romer, the laureate, looks at?
Yeah, and it's very partitioned.
I agree. And it's more partitioned than years ago.
Yeah, and so my career started at the state of Texas studying the incidence of tax burden on Texas households, and I took that throughout my entire career. After the financial crisis, we could no longer look at households in the aggregate. We slice and dice it by income, by ethnicity, by age group, because that's the only way you can understand households today.
If I say, gentlemen, I get criticism about this. If I say that half of America's flat on their back, is that accurate?
Yeah, more than half. More than half. The top income quintile represents 40% of all consumer spending in the U.S. And their appetite right now
They're the ones
is
in Italy or Greece.
They're the ones in Italy or Greece.
I'm at McDonald's, you're in Greece, John's in Italy. I mean, it's great.
Yeah.
We know where that quintile.
You're at the car lot.
But that's the point, is that the concern is that when do we lose them?
Right.
We lose them when white-collar layoffs spread and rise. And that's so that we're watching that very closely.
Neil Dutta of Renaissance Macro is watching this very closely. He's listening, and he's got this to say. The quit rate just rose, claims are down, auto sales are up, housing is up, fiscal's a tailwind, rates are up to 4%, stocks are okay. What's that tell you? Neutral is higher. What's it tell you?
Well, it tells you that near-term neutral is higher, right? And so near-term neutral can fluctuate. The strength of the economy and inflation will tell you that near-term neutral is somewhere higher. That's where the Fed is chasing neutral now. Longer-term neutral is more structural. And that's something, over the next 10, 15, 20 years.
Is our start as low as Williams says, or are you in a camp where our start's elevated?
I don't think structurally anything's changed about the long run neutral rates that will continue to be under pressure. I think near-term neutral, and Neil makes great points. I think near-term neutral is higher, and that's what the Fed is chasing.
Fascinating.
We're up to 42
Got to get Neil on.
Neil's
in a bit of trouble. Yeah. Can I tell you why Neil's in a bit of trouble?
No, I miss this.
It's Payrolls Friday.
Yeah.
He's on vacation with his wife. It's their 10-year wedding anniversary. Happy anniversary. He's logged into the Bloomberg terminal for payrolls. So can we wish Neil and the missus a very happy anniversary, TK, on behalf of the team here at Bloomberg Surveillance?
I'm going to tear up and get emotional, you know.
I think that gets you in a little bit of trouble,
Mrs.
don't you?
Dutta should join us on the terminal.
10-year anniversary.
We can do an interview with both.
You're logged into the Bloomberg for payrolls. We'll get Neil on the phone.
What's wrong with that? That's normal.
We'll work that out. Ellen loves this.
That's normal.
It's a privilege always, every Payrolls Friday, to do this with you. Thank you. Ellen Zentner there of Morgan Stanley. TK, the jobs report, about 45 minutes away, 47 minutes away, something like that.
You know, they're all different. And this one, I can honestly say I've never seen this after the ADP. We haven't talked about it yet. But which ADP report did we see yesterday? Did we see an old-style ADP that everybody suggested was screwed up? Or is this a new one that's got some accuracy? We'll get a proof point here at 8:30.
Enough to make you nervous.
Yeah.
That's for sure. That's
Particularly
for sure.
if you're in the bond space.
Does it change July? I think a lot of people were looking for July for a hike anyway, Tom.
Yeah, well, Zentner shifted over a couple. You know, she was fly fishing somewhere, and she said, "Let's raise rates in July."
If you are just tuning into the program, welcome to the program. The S&P 500 right now. On the S&P, slightly negative. We're negative zero.
Hudson or East River. I'm not
negative
sure
0.08%. Coming up very shortly, the payrolls report. Neil Dutta of Renmax saying the wife loved that. He's not in trouble anymore. So, Tom, that's good news. He can stay focused on a payrolls report, and maybe he could talk about that a little bit later as well.
So much for that marriage.
8:15 Eastern time. Going into that payrolls report, we're going to hear from Randy Krosner, the former Fed governor. Looking forward to his take on things. We'll catch up with him coming out of the jobs report as well, Tom.
This is critical, and what Krosner would say and what Ellen Zentner of Morgan Stanley would say is off to the right-hand side of the equation is this thing epsilon. It's a Greek letter that looks like a baby E, and the answer is, John, nobody has a clue what that uncertainty is out there in a pandemic America. I can't say enough about the importance of the Liz Ann Saunders scatter dot chart today on real yields, and it clearly shows, John, how unusual in the lower left quadrant is 2022. This is about the pandemic, and I would suggest with respect, it's still about the pandemic.
We need to talk about the politics as well, TK. Where is this labour market going to be? Never mind year end. What about November next year, going into the election? Where's this labour market going to be? Terry Hayes of Pangaea coming up shortly.
Yeah, we had our first meeting yesterday, folks, on the political path to the first Tuesday of November. It's upon us with the Republican debates in August.
You want to talk about how that meeting went? It was just you and I shouting across the newsroom.
Could you imagine
that was
the
the
two
first
of us
meeting?
moderating a Republican debate?
It would be entertaining.
I'd have to have extra tang for that.
I don't know if the RNC want that.
I don't think they would.
No. Terry Haynes of Pangaea Policy. He's coming up next. Futures, slightly softer. Payrolls, still ahead.
Steve's ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He's a day trader. He called himself self-made day trader. Yeah. And so he's on the bus after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot.
You know, in many ways, it's a convention, right, of the people that I don't see maybe once a year. And so it's kind of all come together. My firm, our charity, our fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. How has that shaped your strategy for the bank? Is this a new normal? Is this like a catalyst? Do you think we're in a new phase for dividend policy overall? That's a great question. I'm Francine Lacqua, and this is The Pulse, every weekday at 9 a.m. only on Bloomberg.
From New York City,
From London, in Sydney,
from Washington,
in Tokyo.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
Here's what I'm watching. You do not want to miss this story. Is there the kind of upside?
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question.
Great question.
Best question I get all night.
Bloomberg, top experts, great questions.
I knew we had to reclaim America's leadership. Now, all over the country, semiconductor companies are investing a record hundreds of billions of dollars to bring chip production back home. We know for too long, China's dominated the production of raw materials needed for critical products. That's why we're building alliances with our friends all across the world.
The President of the United States, industrial policy, the shifts we're witnessing right now worldwide, something we've got to track for the foreseeable future, and particularly going into the election campaigns of the next 18 months or so. If you are just tuning in, welcome to the program. We're counting you down to the payrolls report, which comes out at 8:30 Eastern Time, about 43 minutes from now. Looking for something close to 230,000 in our survey here at Bloomberg. Going into it, the market's developing as follows. Equities a bit softer, but no drama. We're down by not even 0.1% on the S&P. Yields taking out new numbers, 4% on a 10-year, 5% on a 2-year, encouraging this idea that the Fed is set to hike again later this month, and maybe again, Tom, in September too.
That's the economic data that we'll see at 8:30 here, and part of the economic data is how it will be addressed. Do you still talk to the Secretary of Labor at 9 o'clock? Are we still doing this ballet?
Well, we've got an acting Labour Secretary.
I didn't know that. We don't have a
confirmed Walsh replacement.
Can you talk to Walsh about National Hockey League? You know, I want the goal.
We can work that out. We can try and get Walsh on this program to talk about
it'd be good.
NHL.
You know, I'd like to talk to him.
Quite a trade for him, wasn't it?
I liked your interview because you didn't do it like an American where we're deferential, please, Mr. Secretary. What do you think? You were like...
Can I say, not everyone's a fan of that. Not everyone's a fan of that.
Well, we're always deferential to Terry Haynes, founder of Pangea, and he joins us right now, Pangea Policy here. Terry, I am bedazzled by what I would suggest is a focus on what I'm going to call the far right, like an old fossil. And then you've got the far left, and I'm going to go to Vice President Harris and the news flow of the last 48 hours, where she's speaking to one part of the far left. Is anybody speaking to America's middle? I mean, the Spiro Agnew, whatever the vice president's name was, the silent majority on both sides of the aisle. Is anybody talking to the middle in the summer of 2023?
Well, you two are not the nattering nabobs of negativism, as Vice President Agnew liked to call the news media. Yeah, they're trying to, but they tend to get drowned out by the extremes. I always say that there aren't two political parties in Washington. There are four factions, and what you saw in the debt ceiling spending deal this spring was really kind of a triumph of the centrists, people coming together over those folks. They're trying to speak to them, but yeah, they tend to get drowned out by the bread and circuses on both ends.
Yeah, well, the bread and circuses on both ends as well. Now we're going to the first calendar John and I are looking at, which is the August debate of the Republican Party. Are they going to speak to their far right, or are they going to actually try to address anybody in the vicinity of the middle?
Well, I think they try to do both. One thing I see in the Republicans, and I saw a DeSantis quote this morning illustrating this actually, is I'm not going to try to puff up my poll numbers in June or July. I'm focused to win in January or February. That's what a lot of these folks are doing. What they're trying to do is try to fuzz things up a little bit so that they essentially keep the far right kind of quiet and understand that there's patriotism at work here from the nominee, but at the same time move towards real centrist policies and talking about what they would do going forward. And there's a real market for that. One way you could interpret what Ellen Zentner said to you in the last segment is that there's 2/3 of the public that aren't really being served by what's going on, and that's a thirsty audience that really wants to hear from new blood in the Republican Party and the Democratic Party. Frankly.
We'll hear from some of them next month in the first debate, which I believe is with Fox News. Terry, many people waiting for this field to get whittled down, to be reduced. Do you think that will be the case, and how quickly can that happen?
Yeah, I think so. Chris Christie gives a good summary of this. The idea is essentially that you get into your first couple of debates, and after that, if you don't land and you don't start expanding your voting count and your percentages, you're going to get pretty quickly starved of the money you need to continue. So yeah, I'd look for this field to be substantially whittled down before the beginning of the year. What a lot of these people are running for cabinet posts and for their own prominence in the party, and that from their perspective, that's not a bad thing.
Terry, a lot of people have already written off Governor DeSantis. It's still pretty early days, and as you know, things can change after debate 1, debate 2, debate 3, whatever. Terry, your view on the governor of Florida now, where are things going?
I think being a viable and clear second place is not a bad place for him right now. I think that Trump's at very much his high water mark. And one way to look at, the way I would suggest you look at what's going on in the Republican Party right now, is you've got half or 60% of folks that already want a Trump alternative. And if they see somebody they think is viable and they think can win, whether it be Governor DeSantis or somebody else, I think those folks flock to him.
Terry Haynes, I'm absolutely fascinated what you would advise the former governor of New Jersey, Chris Christie of Newark, a former catcher in baseball. He's now a little bit bigger, I think, to be the backstop on a wild pitch. But what would be your advice to Chris Christie to gain momentum?
Well, I think really two things. One is that I think he's taking on the role of of the anti-Trump and making the case very forthrightly. And I think that's something that you need to do, and I think that does help him. But I'd also build out his economic message. He's great at saying that he compromised with the Democratic legislature in New Jersey, but that's not going to cut it for a lot of Republican primary voters. What needs to happen for Governor Christie is he needs to talk a little bit more about what he'd do economically and how he'd help that half to two-thirds that don't feel helped in this economy.
Is it a penalty for him to be from New Jersey? I mean, how does he play? Forget about DeSantis, Florida, or the other more MAGA states. I mean, it's a whole new calculus, isn't it?
Oh yeah, it's by. You're absolutely right that it is a detriment being from New Jersey, and frankly, he needs to talk a lot more about his record. And I don't mean going granular, but a lot more about what he was trying to do in New Jersey, how he breached those gaps. Bipartisanship is not the end goal, but it's part of what was necessary to do what he wanted to do, and how he'd do that nationally.
Terry, just a final word on China, if you will. There's a new word buzzing around in the last 24 hours. It's not de-risk, decouple, it's diversify, from Janet Yellen, the Treasury Secretary. Terry, I wonder what you made of that, and does that set the stage for a meeting between the leaders later this year?
Well, I think that's a good one. My view of the China business, as you know, is that China's rope-a-doping the United States along, and now I think it's more likely than not they get that meeting, but it is not likely that we get anything substantive for them.
I mean, my takeaway from this interview, it's always a benefit with Terry Haynes.
I know
but the
what your
major
takeaway
issue
is.
here, John, is the way Haynes throws shade on New Jersey.
Quote.
I mean, can you imagine it with the New Jersey State Police on the
You threw shade on New Jersey. You threw shade on
Terry,
New Jersey.
your words. It's a detriment to be from New Jersey. That was
well, no. If you're a presidential
quote.
candidate, the Republican Party, sure.
Terry Haynes of Badger. Terry, thanks for clarifying. Terry, appreciate it. Good to catch up as always. This is going to ramp up later this summer, TK. It's going to come up quickly. It's already July. First debate in August.
I think everything shifted forward 3 months. I think what we think about in February of the election year is going to happen in November and December. We've got a little bit of history now with 12 people on stage or whatever the number is. 1 cycle, 2 cycles. And the key insight there, seriously, folks, from Mr. Haynes, is it's going to get whittled out quickly. Says who? I mean, these people will hang on forever. It's like you and me. They want to get rid of us. But, we love the lights. I mean,
I'd love to hear from Team Trump on one issue. Greg Valliere raised this from AGF Investments earlier this week with us. Does the former president need to go into those debates next month? What's the value there for him?
I mean,
does he need to go? He's got a solid lead.
Given the litigation stream, the potential litigation stream, on and on and on. What's the upside for him to be in a debate right now? I don't see it. I don't see it.
Maybe that conversation picks up. It's jobs day.
It's jobs day.
Payroll's just around the corner. 230,000 the estimate. Great lineup of guests for you coming up shortly. Nadia Lovell of UBS will be joining us. Randy Crosner, the former Fed governor, we'll catch up with him a little bit later. Equity futures, stocks negative here by not even 0.1%.
Welcome back to another special Wimbledon update for Bloomberg TV and radio from Tennis Channel. I'm Andrew Guy. Liam Brody gave the home fans plenty to cheer as the Brit stunned number 4 seed Casper Ruud on center court in the biggest win of his career. The wild card closing it out 6-love in the decider after 3.5 exhilarating hours. Brody's reward is a meeting with Denis Shapovalov in the 3rd round. And don't forget, you can watch all of the action daily on Tennis Channel. It starts at 5 p.m. Eastern. I'm Andrew Guy.
From the world of politics.
We're not going to be relying upon countries whose values we don't share.
To the world of business.
It's all about corporate power at the end.
Balance of Power. Live from Bloomberg's Washington headquarters.
We're going to be more excited what's in store for you.
How long will it take? How many years? Why don't we take this one day at a time?
Good luck. Everybody has a perspective.
Every weekday at 5 p.m. Eastern Time. Join hosts Anne-Marie Hordern.
It's the one area, really, of bipartisanship.
Well, I think we're getting more of it.
That's optimistic.
And Joe Matthew.
The debt ceiling is looming. How close are we going to get to the line before you start to worry?
Alongside Kaylee Langs.
The door was open
for regulators to do more. And that puts the Fed between a rock and a hard place.
As they deliver news.
This is such an important economic issue.
He's no longer trying to run away from
that really blew some minds.
Insight.
We can both invest in law enforcement and also make sure that communities feel safe in their own skin.
And analysis.
I think your audience would get this more than most.
This is not the Republican Party that you know.
It allows him to do what he did so successfully in 2020, which is run against crazy.
From and about politics' biggest power players.
This was the zombie case, and it's now more than well alive.
That's for sure, with two more potentially to come.
I'm willing to have this battle.
It is vitally important. This is the intersection of Washington and Wall Street.
Bringing people directly to the decision makers that impact your investments and your life.
Balance of Power, every weekday at 5 p.m. Eastern, only on Bloomberg, your global business authority.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
So what's the best investment advice you've ever been given by anybody? The compound interest, the compounding of returns is an incredible miracle of business, finance, and human existence. Everything you learn is additive every day, and if you keep at it and don't quit, it's an incredible miracle. And it's not just interest. It was always said about compound interest returns, compound business returns, compound human returns. They're all very additive because you learn every day. And if you keep at it, it's very, very helpful. In your observation of investors, what do you think is the biggest mistake that average investors make? Selling at the wrong time. And they sell when the prices go down? Yes. Or yes. Not keeping, look, people have conviction, or they invest for if they invest for the right reasons, just keep at it.
Today's CFOs are reshaping the C-suite. Bloomberg's Chief Future Officer shines a spotlight on these dynamic leaders. Fenway Sports Group has become a $10 billion global powerhouse. CFO Julie Swinehart tells Tom Keene how she's helping the company raise its game.
Winning's at the core of everything we do here, and the balance sheet is so important to the success of the team.
Watch Chief Future Officer Wednesday on Bloomberg.
These are periods where you're seeing a lot of chop in the economic data.
There's too much labor hoarding going on, not yet enough labor shedding going on.
If the Fed is looking to loosen the labor market, we're just really not seeing that in the data.
3.7% on unemployment is not going to catch the Fed's attention. 4.5% will.
We're still looking at a very tight labor market right now, but I think there's continued pressure ongoing when we look at the stance of monetary policy.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene on radio and television. Jobs Day, Bramo. She's taking a job. She's portaging on the Racket River. She's on like 4th lake or 5th lake or 3rd lake.
Is that what she's doing?
Yeah, the deer flies, they're like a B-52 bomber at Camp Drum. The deer flies are so big the wings sag.
I got eaten alive by mosquitoes. Some of the bites.
But they're Italian mosquitoes, so they're like, it's like upscale mosquitoes.
They're more fashionable.
Yeah, but
mosquitoes.
gelato, the gelato keeps them away as well. It is Jobs Day. We welcome all of you. Moments ago, to show you how unusual this is, Ian Shepherdson of Pantheon. He's been wonderful. John, payrolls are a total wild card. That from Ian Shepherdson.
Well, particularly after the report we got yesterday from ADP, which was 497,000. The estimate this morning in our survey for non-farm payrolls, 230K. The number drops in about 29 minutes' time. A lot of people on board with this idea the Fed hikes again in July.
Yes.
That number would have to be terrible to reintroduce the idea they won't. Anand Zetner said it would have to be sub 100K plus. You'd have to get a soft read on CPI next week.
And the answer is 170 doesn't do it. Citigroup just republishes before the report, and I like this, John. Discuss it. You're more up to speed on what they're doing than I am. A lack of loosening is not evident, is from Allen.
And that's not compatible with return to 2% inflation. That's Citi's view. For me, Tom, and for this note from Andrew this morning, I think this is important. This is less about July. It's less about September even. It's about setting the stage for policy beyond then, when the chairman has to go to Jackson Hole and potentially deliver another address. Now, Andrew said this morning, the risks are rising that the Fed will once again need to deliver a more hawkish message, perhaps at Jackson Hole in late August and or in September at the FOMC meeting. Now, that's a completely different game away from the will they, won't they hike in July.
And dare I say, it gets us to the drama of November. November 1 is the meeting after September 20, but this lack of loosening, within the continuum of all the data we're going to see here in 27 minutes, John, a lack of loosening is the heart of the matter, however you want to look at that, whichever data you want to look at. It's not happening.
Well, let's pick a single data point, 3.6% unemployment. That's the estimate today, down from 3.7. The Fed before had unemployment year-end of 4.5%. That projection has come down to, where are we now, 4.10 for the end of 2023. They've had to completely change their view on where unemployment is going to be year-end, based on how resilient this labour market has been at the top line, the headline numbers that we've seen recently.
And to what Zentner said socially, and this goes to the interview with the acting Secretary of Labor today, and the basic idea here, John, is a partition in America. We can talk all we want about business class, name the airline, forget about it. Ellen Zentner of Morgan Stanley made very clear more than half of America, as a general statement, is flat on their back.
People are struggling. We know that. If you're a debtor right now, Tom, you don't have the cash to park at the front end of the yield curve and pick up 5%. That means nothing to you. That means nothing to you at all. You know that. There are two different worlds right now with 5% interest rates. It's affecting people very differently.
Well,
not just in the US, but elsewhere too.
Let me get this up right now. I can do this. USGG. Some of us memorize the functions on the Bloomberg terminal. John is better at it than I am. We have a whole speed index that really revolutionized things. Moments ago, John, we had a 30-year bond leap, I say leap, above 4%. That happened yesterday midday, and it's come back again right now. The benchmark 30-year bond, long ago, John, the benchmark, back when the Dow Jones Industrial Average mattered.
It still matters.
30-year yield mattered. 30-year yield, 4.01%. First thing I looked at today was a new high on a 30-year mortgage.
Well, the first thing I've looked at over the last couple of mornings is not just the front end of the US curve, it's the front end of the UK curve. So I'll raise you GUK G2 on the Bloomberg terminal to get the front end of the gilt curve up. The 2 years, just remarkable, Tom. We're looking at 550. And bank rate, there's a conversation through this week that bank rate at the Bank of England could go through 6 over the next 9 months.
And this is not a Vin Scully remarkable, the great Dodger voice, and the way he used remarkable. John, I take the point of a number of people. I'd really, when you speak to Dr. Alarian today in the 9 o'clock hour, I think this will be really interesting. To me, it's almost a panic move. It's got a what we call stochastic character to it. It's not like a lift, which is what we're seeing in the U.S. It's a spike up.
I'm pleased you brought up Mohammed, because he's written a new column, and it's about the over-reliance, over-dependence on monetary policy to address the demand side of this inflation equation, and not a big enough willingness to be open to doing something, Tom, more structurally on the supply side. And that's going to be something we have to talk about a little bit more, and we'll do that as well in about an hour's time.
It's going to be interesting to see. On the data front, I'm looking at disinversion, 105 beeps out to 95 beeps, less of an inverted curve. And the 10-year real yield, I'm sorry, it matters, 1.80%. I thought Mark Cabana of Bank of America was brilliant this morning.
He was great. Couple of days of losses on the S&P 500. Will it become 3? The fate of the session, I guess, dictated to some extent, to a greater extent, by the payrolls report, which drops in about 24 minutes. Equity futures, stocks softer on the S&P, down by 0.1% on the S&P 500. And you see it there, Tom, again, nominal yields higher by 3 basis points, 10-year, through 4%, comfortably so now, 4.06% on a 10-year.
We start strong in this jobs report half hour with Nadia Lovell, senior U.S. equity strategist at UBS Global Wealth Management. It's an econobabble half hour. Let's bring it right over to equities. The pullback that we've seen recently, is it the end of this surprise bull market, or can you own equities through this jobs report into Q4 of this year?
Look, I think that you can own equities, but I think you have to be selective in equities. Tom, you've been making a great point around real yields, and we have seen the market fly in the face of higher bond yields so far this year and stretching valuation and really lowering the equity risk premium. But this past week, the economic data that we've got, we're starting to get a gut check, and it's really causing the market to reprice growth and what it means for the path of monetary policy. Of course, a stronger economic environment can mean that we can see a faster recovery in the earnings, but what are you paying for those earnings? Our valuation is still too high.
You beautifully frame it. That's where I am and where I've been for the last couple days. If we get the kind of economy that seems to be dealt with this right now, does that sustain nominal GDP, top-line GDP, and does that sustain revenues where everyone's going to get wrong once again the earnings call, the earnings gloom?
The earnings have been coming in better than expected, but they're still negative, Tom, in the first quarter. In the second quarter, the consensus is looking for a 7% contraction. We do expect that to come in better than where the consensus is, just given how strong the economic environment has been. But when you look in the back half of the year, we do expect the economy to slow down, and we also are expecting inflation to improve. Quite frankly, we're looking for core CPI to trend towards 3.5% by the time we get to the end of the year. And so that inflection that you're seeing in earnings in the consensus number, the 8% growth that they're looking for in the fourth quarter, we just don't think that that's likely. So we think that there's going to be a little bit more trimming come to the back half of the year earnings outlook. But for Q2, we do think that earnings will likely beat, but you're not going to see the same follow through in terms of the price reaction as you've seen in the first half of the year.
Nadia, let's say you're right. Where would you expect resilience to be within the equity market beneath the index?
We think that, in our preferred sectors, we recently actually upgraded the energy sector in the last couple of weeks because we do think a bearish outlook is overly priced in that sector. Oil prices have struggled year to date, just given to supply that's come into the market stronger than expected, particularly from Russia. But you are starting to see the impact of the production cuts from OPEC Plus. We're already seeing crude export at a one-year low, and that's likely going to go lower, particularly as Saudi Arabia and Russia implements additional cuts. So we think that there are some opportunities there within energy. The energy companies are still very strong balance sheet, strong free cash flow and dividend yields. Within energy, we like the oil services companies as well as E&P and some of the integrated. So the numbers have come in, we think, far enough now for energy, and that could be a good setup in the back half of the year.
Nadia, that's going to be a little bit hard to digest for some people, that you're looking for this downturn and bad earnings and ultimately an economy that won't do so well, but you still like opportunities in energy. How does that add up?
Yeah, it's really the global economy as well. And even though you might see some slower economic growth in the U.S., overall, oil demand still remains quite high. And we think that this imbalance that you're seeing in the market is going to correct itself, and we're looking for a deficit in the second half of the year. So some of it is the supply coming down to be able to have the market in deficit in the second half of the year. So it's a bit of a more of a contrarian call. But again, we think that the energy sector is already priced in a recessionary environment, and we're not calling for a recession in the second half of the year. We're calling for more subdued growth.
Is the UBS view persistent free cash flow? This phrase, I detest this, Nadia. We need to buy quality. What's quality right now?
Quality of those companies that have absolutely good free cash flow generation, more resilient earnings, and also it's just overall stronger balance sheet. So even in tech, I would say, Tom, even though we have a least preferred preference on tech, we're not necessarily saying to go out and sell all your tech companies. We're saying to focus on the more quality companies, the defensive areas of tech, and rotating out of the more cyclical, highly cyclical areas of tech. So overall, it's looking for good free cash flow generation, also a bit of a return to capital as well, defines what we think as being quality companies.
Nadia, just identify the key distinction there. Just to finish there, I think this is important. Defensive and cyclical tech. What's cyclical? What's defensive?
So within tech, the more highly cyclical areas are the semiconductors the sector industry. It's outperformed year to date, and so what we've been advising clients to do is lock in some profits there and rotate it in the more defensive, the laggards, the mid-cycle plays, so software companies. Obviously, we've had an AI frenzy, and we do like AI longer term, Jonathan, but we want to be a lot more selective at this point. We still see some opportunities, some good risk reward within like the network areas, the memory areas because of AI as well.
Can you see in August Nadia Lovell popping off 85 pages on AI?
I can, yeah.
You know, she's going to go in the office and she's going to be like, I'm taking the last 4 weeks
Why did they make
off.
them do that? Why did they make them do
to punish Nadia? You know, there's some grizzled guy on a phone in the Hamptons
Some poor
calling
analyst
into
somewhere.
Nadia who's killing herself. Nadia, by Labor Day, we need 85 pages on AI. Do something. That's how it works. That's the real world.
And then how many people read it?
But Tom,
no, they
by
read the first
Labor
3.
Day, by Labor Day, a generative AI might be able to produce that.
Nadia, thank you. Nadia Lovell of UBS. I once did a little conference on this with the research team over at SocGen in Paris, maybe 9-10 years ago. I remember the conversation, and there was this guy there who said he wrote this long PDF, wasn't affiliated with SocGen, just a little committee, a conversation about how to improve the Southside research. And he said that he'd done this long PDF, and at the back he'd put a note to see if anyone would actually get to the end and read it. No one ever wrote it. No one had read it.
When I lecture on this, they say, how do you read a research report? And I say, if it's 4 pages, read the first page, find 1 paragraph inside. If it's 12 pages, 1-2 pages, etc.
If you are just joining the program, welcome to the program. Equity futures this morning, negative by 0.1%. Coming up in about 17 minutes' time, the payrolls report. And going into that, we're going to catch up with the former Fed Governor, Randy Kroszner. Mike McKee just walked into the studio, so you know it's game time. You know it gets important, Tom, when McKee steps in and gets ready to go.
Straps on the CCM tax, and he comes in.
You know it's summer. I tell you what, McKee, after Memorial Day weekend, bang, white pants.
You know,
every
like
single
time. You and I are
time.
sitting here doing the boring false
Every
suit
single
thing.
time.
It is. It's true.
Well, this is like the year-round
I like what
suit, right?
I like what Ian Shepherdson said. Nobody has a clue. I mean, I'm paraphrasing. nobody has a clue at 8:30, folks. Stay with us. It's a mystery.
Isn't that like the worst-kept secret on Wall Street that no one has a clue going
Nobody
into
has a
payrolls
clue.
every Friday?
You know, you got to be here at 8:30. McKee's going to tell you how the rest of the day is going to go.
McKee, Lindsay Piegza, Randy Kroszner, all coming up in the next 20 minutes. From New York, the payrolls report just around the corner.
Was going to keep rating World Cup. This is a 3
as the economic picture does.
The OK is getting ready to make a decision.
A lot's happening on Wall Street.
There are so many factors at play today.
It remains tight in certain parts of the economy.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insight.
Crisis is too strong a word, and words like that get used a lot.
From businesses most influential and instrumental.
America's economy needs a diversity of institutions. That's something that Wall Street pays a lot of attention to.
Bloomberg Wall Street Week, live tonight with replays all weekend on Bloomberg Television and Radio.
Welcome back to Bloomberg Daybreak Europe.
Good morning, good morning. This is Bloomberg Surveillance.
Welcome to Bloomberg Markets, trying to open.
This is Bloomberg Technology.
Welcome to Balance of Power. This is Bloomberg.
If you just step back and you look at this labor market data in particular, we've surprised month after month to the upside We continue to see these jobs numbers coming in stronger. If the Fed is looking to loosen the labor market, we're just really not seeing that in the data.
The View from Citi, Andrew Hollenhorst there, looking for a hike this month, looking for a hike again in September. The data, 14 minutes away. The payrolls report coming up very shortly. Going into it, equity futures, stocks a bit softer. Not in a big way, no drama here. We're negative 0.1% on the S&P. Yields have been moving dramatically higher. I have to say that. Following ADP yesterday, they were surging at one point for the first few hours. Yields up through 4% on a 10-year, at 4.06% on a 2-year this morning, up 3%, up 3 basis points rather, through 5% on a 2-year, Tom. Quite a development in the last couple of weeks.
Huge development, and again, it's a shifted data screen. If you look at the Bloomberg Launchpad, which is a fancy gizmo, we have equities, bonds, currencies, commodities. You can program it any way you want. John, it's just simply a changed screen. There's no other way to put it, with a 10-year inflation-adjusted yield stuck now up 3 beeps, 1.80%.
Well, we certainly turned the volume up on the jobs report yesterday, didn't we? Yeah. Following that data, just blowout numbers that we're still trying to get our head around from ADP.
Right. Uncertainty is in order, and that is a good place to start with Randall Krosner. Randy, the Bloomberg interns have invaded the building. I was speaking to a whip-smart intern yesterday, newly minted after reading Krosner out of Babson College, the pride of Wellesley, Massachusetts. And that intern, he said, "What should I read?" And I said, "You've got to read Peter Bernstein. It's required at Chicago on risk and uncertainty." Tell me right now how uncertain you are about the American economy, the American labor economy, this jobs report post-pandemic.
I think the uncertainty is pretty high because, you know, as you guys were discussing before, it seems like the labor market should have started to slow down a bit, but we haven't seen much evidence of that. Certainly the ADP numbers yesterday and other data suggest that the labor market's still pretty hot. You know, there are long and variable lags, as my, great predecessor at University of Chicago, Milton Friedman, had talked about. But man, these are really getting to be very long on lags. You think you start to see something by now. And that's the uncertainty. How high is the Fed going to have to go? Because the Fed's not going to quit until the labor market quits.
If the Fed, and the mystery is how high do they have to go, are these normal meetings forward, or do the PhDs, the people that worship your financial economics, do they have to amend every discussion as they get out to November 1 meeting?
Well, I think what they've got to do is try to see, are there some structural changes in the economy? And I think there have been at least some changes, whether they're permanent structural or not so sure about. Probably something structural for the labor market. We certainly see lower labor force participation. A lot of older workers have said, there's no way I'm going back into the labor market. I don't care that wages are high. I know too many people who didn't make it through COVID. I want to see my kids, my grandkids. We also have seen with the very low interest rates during the pandemic and just coming out of it, that everybody refinanced. So normally you have the transmission mechanism of monetary policy having an impact on interest rates, and so having an impact on people's payments of houses, et cetera. But so many people refinance into very low fixed 30-year mortgages. It doesn't matter as much to the economy that interest rates are going up, because people's income is not being affected by that, or at least a smaller fraction of people's income is affected by that than normal.
So, Randy, with that in mind, what's the appropriate role of the Federal Reserve with that as your backdrop? Is it to just keep pushing, or acknowledge everything you just acknowledged?
Well, it might mean that they need to go further than in the past. Now, I don't think they're going to have to go as far as in the late 70s, early 1980s, because fortunately they started before inflation expectations got out of control, because that's what happened back then. Inflation was in the low double digits, and they had to bring interest rates to 15, 20% because the Fed had lost credibility. Inflation expectations went up, but really not that much. So that's a positive. But it may mean that they need to do more work in raising rates to get the same impact on the economy of sort of taking some of the heat, particularly out of the wage demands.
So, Randy, this debate often comes down to 1 or 2 hikes. Now, 25, 50 basis points is nothing. What kind of numbers are you talking about, thinking about?
Well, I'm certainly. I think. Well, we'll see what the data say about the labor market. Maybe the labor market's about to crack.
Sure.
Certainly, the data don't suggest it. But if it doesn't, they're going to keep at it. And I think they're going to end the year closer to 6 than they will to 5.
Okay, Randy, this is great. We're going to get a jobs report. We're going to talk about all the econobabble and that, but I want to bring it over to finance. I want to bring it over to what you actually teach at the Booth School. Can you tell the students at Booth, entering last week of August, whenever it is they get through their 8-week orientation, can you tell them that we've reached financial stability?
We're not sure. So it gets back to the uncertainty that you had talked about before. Because obviously with the very rapid increase in interest rates, we've had an impact on banks like Silicon Valley Bank.
Yeah.
They thought they were geniuses by buying long-dated securities. That was fine until interest rates went up so much that the value of those securities plummeted. And you've got some other institutions that also have a lot of effectively long-term fixed rate things on their balance sheet, long-term is commercial real estate, particularly commercial real estate. That's, I think, going to be a challenge. And so we're going to see how that plays out. And I think when we start getting the next round of bank earning reports, there may be a little bit of tumult around that.
I mean, I'm not going to mince words, Professor Krasner. I look at the stress test. The stress test is a comedy. I mean, I just don't think they had any value at all. But after SVB, from where you sit, have we seen a new enhanced financial supervision? Is there something new in the religion of looking at the banks after what we saw a number of weeks ago?
I think one thing that they are now focusing on is interest rate risk. So other signatories to the so-called Basel III regulations, the capital standards that came out from the global financial crisis, virtually everybody has an important rule related to interest rates and interest rate risk. We didn't have that in the U.S. And so I think that's going to be the key thing that changes. And my hunch is that my former colleagues at the Fed and the other regulators are keenly focused on that issue now, and they weren't before.
Randy, stay close. Jobs report, 7 minutes away. We'll catch up with Randy Krasner in just a moment and get his reaction to that. Mike McKee with us around the table, logged into the Bloomberg, waiting for that data.
Waiting for the
ready
data.
to go,
Is
Mike?
it embargoed?
Ready to
Do
go.
you know, but you can't tell us, or do you not know what's going on?
No, I don't know what's going on. They've changed the system. We all get it at the same time. Interestingly enough, I was on a little while ago with you guys, and the whisper number was 270. Now it's 280.
Really? You changed the whisper number?
Maybe I did, but Wall Street clearly leaning into the idea of a strong payrolls report. And I was mentioning earlier to you guys, Ben Emmons from New Edge out this morning with a note that says he's got a model that shows 734,000 jobs. So that would be fun.
I'm afraid to ask.
That would be fun.
Who are the people that combine the whisper number?
Well, it's anybody on Wall Street who has a Bloomberg can put in their estimate of what they think it's going to be. I'm sure we get herd mentality.
So we got a foreign exchange trader working for Mark McCormick up at TD Securities, whose expertise is dollar Mexico, and he's typing in a whisper number.
A lot of those estimates that come in our Bloomberg survey economists, Mike, they came in weeks ago from many places.
Well, you know, after you get a number like ADP, that there's going to be some upward revision, and we did see that to 230 from 225. A lot of these are not Wall Street economists who are constantly updating.
Or following ADP.
Well, it was interesting to see all the notes that came in after ADP, because some people said, oh, we got to change it, and other people said, no, we don't believe this number.
Will we believe the number that comes out in about 5 minutes' time, Mike? We had some wacky numbers. Remember, household establishment survey.
There's a whole debate about that.
Big distinction.
Is the labor market numbers accurate, given the weirdness of the labor market?
What does that even mean? Are they accurate?
Well,
what does that mean?
The birth-death numbers, for example, it's a plug-in number that the Labor Department puts in, guessing at what the new job formation is and companies going out of business, and they don't really know, and it tends to be inaccurate around turning points.
Interesting. Mike McKee on the jobs report. In about 4.5 minutes' time. Coming into it, here are the scores. Equities a little bit softer, down on the week, down on the session. We're negative 0.1%. If you go to cash, you can pick up some yield. 2-year through 5%, 10-year through 4%. That development in the last 24 hours following a blowout ADP report. The estimate 230,000 in the Bloomberg survey. The number is up next.
for the first, call it 18 years at Chipotle, this was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1.
Right.
So it's ready right when you pull up your car.
How do you manage these kind of two different staffing needs, right?
Yes.
And making sure you have the right amount of people at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple of people, our average restaurant now does about over $1 million per restaurant in digital sales.
3 prime ministers, 4 chancellors, an energy crisis, and the soaring cost of living. It's been a hard year for startups, but even in the toughest times, some of the best ideas are born here in the UK. Bloomberg UK's Startups to Watch will profile the brightest companies under 10 years old, with the winners unveiled at the Bloomberg Technology Summit in London in October. Get your entry in by the 7th of August for the chance to have your company profiled and to attend unique networking events. Good luck, and we hope to see you there.
Jobs report in America, seconds away. Here are the scores going into it. Equities a little bit softer, negative by, let's call it 0.1%. Phenomenal moves in the bond market over the last couple of weeks, including the last 24 hours. A 2-year through 5%, a 10-year through 4%. The estimate today coming into this print, 230,000. The payrolls report with Mike McKee right now. What do we got, Mike?
Well, we're waiting for the numbers to drop. 209,000. It is a lot lower than anticipated and a lot lower than it has been. 339 last month. I'm looking for the revision to that. We'll get that in just a second. But, of course, the forecast was for 230, and we had that blowout ADP number yesterday. So this is quite a surprise. Private payrolls, 149,000. That would compare with that 497,000 that ADP found because they measure private payrolls. Manufacturing up 7. That's a change from a negative number the month before. And the unemployment rate does fall back to 3.6%, which is what had been forecast. It is a little unusual to see unemployment dropping when we are waiting for the Fed to keep raising interest rates to push it up. Average hourly earnings come in stronger than expected, a 0.4 gain for the month of June. And on a year-over-year basis, that puts it at 4.4%, which is not the direction the Fed was hoping for. That's up from 4.3% in the prior month. Here's the revisions. Last month, which was 339, now revised down to 306. So a little bit weaker for the last 2 months then. And the change in manufacturing payrolls, which was -2, is now -3. However, the average hourly earnings revised up for May to 0.4, and that put May at 4.4. So basically, we're unchanged between June and May. Negative 110,000 total revised jobs for April and May going into June. So what we're looking at is a little bit weaker than, a lot weaker than anticipated. And it's the first month in the last 15 that's come in below the economists' expectations.
All the way back to the March report of last year, which we got in April of last year. Amazing.
Yeah. Do the markets, John. I think it's important here.
Let's push it through this market. Equities recover a little bit. They pop. They turn positive on the session. We're up by, let's call it 0.1% on the S&P. We were slightly negative going into the print. Off the back of this downside surprise on the headline number, payrolls at 209K. Bid at the front end, you might expect that. Yields lower by 5 basis points. We break back down through 5% on a 2-year. Let's call it 492. Off the back of that, you'd expect some dollar weakness. You've got that. The euro against the dollar back through 109, 109.13. We're positive by 0.2% on that currency pair. But I'd say a couple of things about this, Tom. Downside surprise on payrolls, but look elsewhere. Unemployment's lower. Average hourly earnings, better than expected, higher than expected.
No question.
Average weekly hours worked, just a little bit longer as well. So some important developments on that front. More mixed than maybe meets the eye. And Mike McKee's going to have something to say on that, I'm sure.
Round of applause. Ellen Zentner, Morgan Stanley, with us moments ago. She absolutely nailed the impossible with the revision. You have a 99,000 statistic that is sub 100,000. This is the slowdown she was talking about, which was an outlier 20 minutes ago. But with 110,000 revision, the math is 209. Take away 110, and you get under 100,000.
The April numbers were revised down from 294,000 to 217,000, down 77,000, and then May down 33,000. We mentioned that. So you see from April, May, and June, a weaker labor market than people thought. So this is probably going to have an effect on the Fed, even if the average hourly earnings are not specifically changed. Not much change in terms of the unemployment rate. While it did go down, we saw 273,000 new jobs in the household survey, and unemployment fell by 140,000. So we've sort of reversed what happened last month when we went up to 3.7. So this is all going to raise the questions of soft landings and things like that if we continue in this area. I might mention that construction hiring up 23,000. So the home builders are really keeping the economy going. Here. The other big employer was government. Government was up 60,000 on the month, and little change, a gain of 21,000 for leisure and hospitality. The BLS puts it as little change, but that compares with 232,000 in that ADP report. So ADP way off this month, and I don't think anybody's surprised to hear that, but the labor market has clearly slowed.
Mike, thank you. You're going to spend a little bit more time on that. Stocks positive, turning positive off the back of this data. Coming up in the next hour, we'll catch up with Mohammed El-Arian, Rick Reeder, Victoria Fernandez, Michael Collins, all on this market, this economy, this payrolls report. Then a little bit later that hour, we'll catch up with Julie Su, the acting Secretary of Labour as well. Tom, just to get the view from the White House a little bit later this morning.
Yeah, they're going to look at it, and they're going to see some softness here with the revisions as well, but they've got to go to some form of wage lift. What we're going to do here, folks, to inform you is Lindsay Pieggs is going to join us here in a moment, but first we have Randall Krosner with us. He's a former governor of the Federal Reserve System, truly one of our nation's experts on our financial economics. Dr. Krosner, I look at this report, and clearly we're finally seeing some some unemployment, non-farm payrolls lessening as well. That buttresses against rising wages. How are those two balanced at that long table at the Eccles building?
I think as Mike was describing, the wage growth is still stronger than the Fed would feel comfortable with, because they want to bring inflation down to 2%. And if wage growth was revised up last month, it's still strong and around 4.4%. That's going to give a lot of people some concern. And so I think they're going to say we need to move forward, even if we're starting to see a slight softening of the labor market. I mean, maybe this will be the turning point, and maybe we'll remember this as that was the last time we had a strong report. That was the last time that we had an overshoot, and that the market is going to and the labor market will weaken. But they really will want to see some evidence that the wage rates are going down.
You know, I look at Chicago and Booth School, and of course there was a professor there that his course, Turning Points and Humility. Austin Goolsbee, Professor Goolsbee was brilliant in that course, Turning Points and Humility 302. What's the level of humility this Fed has to have? Can they take what we're seeing right now, a non-farm payroll slowdown, and use it as 1 point, or do they have to see some form of moving average?
They don't overreact any one number, or even any one revision. So they're going to want to see something that is a sort of a sustainable trend downward in wage pressure. So if they see that the labor market is starting to weaken, and that the unemployment rate starts to move up, job growth starts to slow down, they'll start to feel comfortable that wages will move down. But they're going to wait, I think, to see wage movement start to move down before they say, oh, all clear, we can just stop. Now, remember, they're just going to stop. They're not going to start cutting. They keep emphasizing that. The markets don't seem to believe it, but I believe them that they're going to hold it. Unless there's some sort of cataclysm, they're going to hold rates wherever they end up finishing in the mid fives, and they're going to hold it there for a while.
Professor Krasner, thank you so much. With the Boost School Chicago, Randy Krasner, so helpful to us on Jobs Day and often when the Federal Reserve meets. Got a green on the screen, a little lift of the market off the carnage yesterday. I'd point out a lot of movement in yields. A 2-year yield comes in with a nice vengeance from a 5 level and now 5 basis points, 4.95%. 2 stents disinverts out to 93 basis points, less of an inversion, and even the real yield pulls back the 10-year from 1.80 to 1.76. The jobs report is 47 pages. McKee's on page 14. What do you see?
Well, a couple of things that are worth noting here. The average weekly hours rose 34.4 from 34.3, and there had been a storyline that employers were hoarding labor, did not want to let people go, but were cutting back on their hours to save money, and it does seem that they were busy enough to get them back to work. The interesting thing about unemployment rates that comes through is that it is the lower socioeconomic groups that are losing ground. We saw for the race groups, Black or African American goes up from 5.6 to 6.0. Asian goes up to 3.2% from 2.9%. Wow. Whereas white unemployment is lower at 3.1 from 3.3. And you look at the people with a bachelor's degree or some college, unemployment went down for them, but those with less than a high school diploma or high schools, no college, it was unchanged or went up. So this does have some of the starting characteristics of maybe a labor turnaround, because you're letting the last hired to be the first fired.
We're beginning to see some bond market movement here as we digest this data. Joining us now, Lindsay Pieggs, the chief economist at Stifel as well. And to me, it's a hallmark announcement, Lindsay, with the revisions. Let me go through the math again. It's simple. It's algebra. I can handle this, Lindsay. I can't do the differential equations like you. And that is 209,000, take away 110,000. Can you frame this out with the revisions as a sub 100,000 report?
Well, I do think it fell well short of expectations, but that being said, it's still a solid headline number. And for the Fed, the focus is not that top line non-farm payroll report. They're looking at the details. They're looking at the inflationary components. And with the unemployment rate declining, wage growth gaining momentum, this is the exact opposite of what the Fed wanted to see. This keeps the Fed on the path for an additional rate increase later this month. And depending on what we see from the inflation data next week, we could see another rate increase shortly thereafter.
Our audiences on radio and television are saying, wait, wage growth, 4.4%, take away 5 or 6% inflation, depending on whether I'm buying steak this weekend. And the answer is they're not getting ahead. Which nominal wage growth does the Fed need to see? 3.5%, dare I say 2.9%. How low do we have to bring down wage growth?
I think if we saw a 2 handle, the Fed would be very comfortable with that. I think that would give the Fed confidence that we're on a sustainable downward trajectory. That's what the Fed wants to see. It's not about getting inflation under control from 8 down to 6. It's continuing that trajectory back to that 2% target.
Give me the x-axis then on a 2.9% nominal wage growth. We're distant from that, aren't we?
Absolutely. Absolutely. And one of the biggest fears for the Fed is that wages are continuing to rise. Growth is continuing to accelerate without any improvements in productivity. And so there we start to see this wage price spiral leaving the economy behind. Growth is slowing. We know that. But if underlying wage components continue to increase, what is the economy gaining from that? It goes back to the old adage of we could hire 1 million workers to make windows, 1 million workers to break windows. If the supply of labor falls short of that, wages go up, but we're not adding anything to the economy.
I want to make clear, we've really got some flightiness on the data screen as well. Right now, red and green on the screen, futures at -8, NASDAQ barely to the green side as well. In the yield space, there is some movement, 4.96% on the 2-year, the 10-year yield, 4.04%. These are all new numbers for me. They're really a shock to see in this high, 4.01% as well. How many quarters of, as you say, 209 is still a substantial non-farm payrolls number, But if we developed a 3-month moving average of 190,000, my reading is that doesn't get it done for the Fed.
Well, it
You've
depends.
still got to sustain.
Where are wages at that point? We
So
have
you
to
really
see.
hinge everything on wages.
Well, inflation. Wages, that's one component of inflation. But we need to get that under control. We need to see some of that tight labor market conditions ease so that the Fed feels more confident that wages will begin to ease. Now, that doesn't mean that they're going to tackle overall inflation then just by getting the labor market to become less tight. There's other components of inflation. But that's the component that the Fed can control. That will determine the terminal level. The other components of inflation will determine how long the Fed is forced to maintain that elevated level of rates.
Give us a Stiefel granularity of what Mr. McKee talked about, which is the racial makeup of jobs. We saw some higher unemployment, some jumps in unemployment among minorities, and also on the education basis as well. The stereotype within financial media is we have a lot of service sector bartenders and waitresses still being employed. Do you buy it, or is there a different story here?
Well, I think there's two different storylines. Certainly, when we look at where the most unemployment is gaining momentum, that's at the lower skills level. We're starting to see technology replace those lower skills. This was something that was happening before the pandemic, but this is a trend that has certainly been exacerbated more recently. But I also think that we haven't yet seen that cyclical component suggesting that weakness is lurking around the corner just yet. As we heard about, leisure and hospitality still posting a sizable increase this month. That would be assumed to be the one area where we would start to see that weakness gain credibility, gain evidence, but we haven't seen that quite yet.
Is this still a pandemic-tinged report?
I don't know if we can necessarily say that the pandemic is influencing this report, but I think the aftermath of the pandemic, the change in psychology, is impacting this report because we're still seeing millions of workers sitting on the sideline, not actively participating as we would expect in the traditional manner in the labor force. So we do need to still think about providing an incentive to pull some of those sideline workers in that may help to expand the labor supply and then organically reduce wages. But we're not going to see that downward pressure unless we see demand for labor precipitously decline or the supply of workers dramatically increase.
Lindsay, thank you so much. Lindsay Pieggs is with us today from Stiefel. She's going to go right up a storm. We'll have that report for you later this afternoon across radio and television as well. McKee's now through page 14. He's good news. He's up through page 25 as well of 42 pages. There's got to be some other things in here. Fascinating report.
Well, there's a lot you can look at in here. Looking at the unemployment rate, what happened there? Well, we did see the labor force rise by 133,000, but more people got jobs, 273,000. Remember, last month they lost in the household survey 310,000, and it was the reverse in unemployment. The level change goes down 140,000, and the prior month was up 440. There's always this tension between the household and the establishment survey, and given the arguments among economists at this point about what the Fed should do and whether the labor market is strong or not, what you probably want to do is pick a side. Are you a household person or are you an establishment person? Most people would be establishment people.
Michael McKee, thanks so much. Right now, we're going to give the focus here on the bond market. It has been front and center since the shock ADP report, a ginormous statistic. And if you're just joining us, we subside off of that to a lesser number. Just critically here on the actual statistic, the survey was 230,000 with a whisper number. Mike McKee said higher. We came in nicely off that, 209,000, but critically with a negative revision as well. It has moved the bond market, which means it's a good time to speak to Ira Jersey of Bloomberg Intelligence. Ira, is the two-year yield of value here to study at 5.05%, plunging now down to 4.97%? Does that give you an indication of the pulse that's out there?
Well, so the 2-year right now is really pricing for the Federal Reserve to hike 2 more times. So around 5.08 should be fair value if the Fed's going to hike to around 5.5%. And primarily because once the Fed hikes, the market is going to keep on pricing for interest rate cuts at some point in the future. We keep rolling forward when the interest rate cuts are going to be. It's always going to be. It seems like the market thinks 6 months after hikes end, but the problem is we keep pushing out when hikes are going to end. So, I think right now, assuming that the Fed's going to hike 2 more times, twos are not particularly rich or cheap. If they only hike once, then obviously twos look a little bit cheaper.
Help us here then with what we see farther out. I mean, the last time you and I talked about a 4% 30-year bond, I think we were younger, Ira, to say that's back when the Tottenham was winning. And the answer here, Ira, is I got a higher yield regime. Does that have a stickiness to you?
Yeah, so I think the long end for the rest of this year is unlikely to basically move, much out of the ranges that we've established for this cycle. And in fact, we are coming to a pretty important technical level for 10-year yields at 4.09%. Now 4.09%, that means if we break that, we probably go to about 4.25. But these again are ranges that we've established over the course of this cycle where we're looking at 3.5% to 4.25%, where we could probably stay there. It's really this, the front end of the curve right now is really what's driving the yield curve inversion. It's the fact that 2-year yields are so high, and the long end is just kind of hovering, 4% plus or minus 25 to 50 basis points.
You said it better than me, Ira. Are we breaking out of the range we've been in on these various yield metrics? Are we breaking through to a newer, higher regime?
Well, yes, temporarily. I think until the Federal Reserve stops hiking interest rates, it's going to be hard to go back and retest that 3.5% 10-year yield. Given that we're saying now, hey, the Fed's terminal rate's going to be a little bit higher, then the entire yield curve has to shift up a little bit, and that's exactly what you're seeing. And obviously, the front end, as you noted before, Tom, the front end is where all the action is, right? Going from, we've gone up about 80 basis points in yield just in the last couple of months in 2-year yields, whereas 10-year yields have gone up, maybe 40 basis points.
Okay, but I understand the United States has a certain lift to the 2-year yield. I would suggest it's radically different than, say, what we see in the United Kingdom and the 2-year gilt. With that said, does the 2-year yield lead the discussion going out, the belly of the curve, the 5-year, out to the 7-year, out to the benchmark 10-year, dare I say, out to a 20-year muni or a 30-year full faith and credit? Does it lead?
So the answer is no. Actually, it's that belly that leads. So you mentioned the 3 and 5 year. That tends to lead because you have more of the future expectations built into those yields rather than the 2-year, which is going to be much more highly influenced by the policy rate and what's going on today with the Fed. So you look at something like the 5-year. We were rallying when we were thinking, hey, the Fed's almost done. The Fed's going to be cutting interest rates in 2024, and then more aggressively in 2025. So that 5-year rallied a lot. Now you're seeing the belly of the curve actually underperform, and in part because now everyone's saying, oh, we might have this higher rate regime where not only is the Fed's terminal rate going to be higher, but maybe they're going to keep the terminal rate there a little bit longer than we expected. The market was not believing the Fed basically until the last couple of months, and now it seems like everyone's saying, the market is saying, hey, we now believe the Fed. We're going to trust the Fed and what they're going to be. What they're saying is what they're going to be doing.
If we believe the Fed now, are we believing that yields move up, dare I say, and migrate to a new somewhere near 6% level?
Well, very few people even at the Fed think that they're going to hike to 6%. The yield curve is going to remain inverted in my view, at least until the Federal Reserve cuts interest rates a number of times. And one of the reasons for that is, that the market is of the belief that the Fed's going to basically be successful at some level, going to see lower inflation, going to see lower growth, and at some point they're going to stop hiking in the next 25 or 50 basis points. Once they do, the next move is going to be a cut, and the market's going to perpetually price for that. And because of that, you'll continue to see maybe a higher rate regime. Like, we're not going back to 1% 10-year yields, I don't think, but we could certainly see we're probably not going to see a 5% or a 6% 10-year.
You're warned, Ira. Ira Jersey. A question from Michael McKee as he looks at the data. Ira Jersey does yield. He's in the real world, unlike you.
He does the real world. How much expectations for the Fed actually pushing around the curve on the short end? Are we seeing people react to the jobs report, or are they reacting to the idea of what the Fed may do with it?
Well, they're reacting to, so whenever we get these data releases, so, it's obviously the payrolls report is the granddaddy of them. And in fact, it actually, the market reaction tends to be twice as large to any miss or beat than the next most important data release. Obviously, CPI next week will be an important factor as well. So it's basically the instantaneous adjustment of the market's expectations for what the data is going to do, where the economy is going to be, that ends up creating these knee-jerk reactions.
Yeah.
Initially we saw that massive rally in the front end in the 2-year yield, rallying 6-7 basis points. We then came off that after everyone, looked beyond the headline red headline number and listened to Mike McKee and saying, well, it's actually much more of a mixed report. It's not just a weak jobs report when you look at things like the wage data and some of the hours work data, as Mike noted earlier in the show.
Lindsay Piegza really emphasizing the wage data with the inflationary push there as well. Ira Jersey, thank you for the brief with Bloomberg Intelligence. For those of you with a terminal, he and his team, I'm sure, will be right now, red and green on the screen. The VIX 15.33, the 2-year yield of 5.05. I'm going to go off where we were at peak. We're down 10 basis points off that, 4.95%. 10-year yield still above 4%. 30-year bond still above 4%. 2-10 spread, 92 basis points. We disinvert over the last 48 hours as well. And the tip was at 1.80 down to 1.75. Now up to 1.78. I can't believe I'm doing all this micro adjustment on yield as well. Edward Harrison holds court for Bloomberg in Washington. He's with Bloomberg Markets Live, and we're thrilled he could join us now because he had to survive the most intimidating undergraduate prospect I know, which is Douglas Irwin on foreign trade and all American trade and our trade wars and trade economics, and ungodly had to sit through Blanchflower 101 up at Dartmouth. Ed Harrison joins us this morning from Bloomberg Markets. Ed, I look at the report, and I look at how you apply it into the real world of what to do at Bloomberg Markets. And I love your phrase, duration seekers. In your recent report on duration seekers, what are the yield hogs doing that desperately want to go out 42 years?
Yes, Tom, I think that the yield hogs are looking to pile into the longer end of the curve, thinking that now is as good a time as any to do that. And actually, up until this report, I would have said that was probably a little bit premature. But interestingly, this report confirmed some of the weakness that I had been seeing in the data. If you look at the rolling 12 and 6-month number of unemployed in the United States through the data back to 1948, what you see is that number actually declines to a low right before a recession, sometimes right at the beginning of a recession, but usually right before a recession. And what we've seen is that in April, we hit that number, that low. And the data that came out today confirmed that both May and June were higher on that rolling basis. And so what that says is that maybe those yield hogs are correct, that now is the time to get into the long end of the curve.
I mean, Ed Harrison, what's so important to me here, and of course this is the heritage of our Washington News Bureau folks, Craig Torres, Rich Miller, and the rest of the thieves down there. And, Ed, I look at what you guys do, and it's always history-based. What is your study of the if and when of how we disinvert? We have massive curve inversion, and I guess at some point that's going to go away. When we disinvert here from 105 beeps to 91 beeps right now, how does that happen?
Yeah, that is a very good question because we've had some bear steepening, and that's caused, say, for instance, a 3-month 10-year to disinvert 60 basis points. But I think Ira was right on the money when he talked about it's the cuts that are the real disinversion that we're considering. And the real question is whether that disinversion happened before or after the recession. You know, in the post-Greenspan era, the post-Volcker era, it's always happened before the recession. That is that we see a disinversion be up beyond zero, so that we have an upward sloping yield curve before the recession. But this could actually be a recession that's more akin to what we saw in 1980, where the Fed keeps it tight right up until the recession and even after the recession.
What are you going to write about today and into the weekend? I mean, you write such a curious piece for Markets Live. You never know what you're going to get from Harrison. What are you thinking about writing about 2-3 days forward?
I'm thinking about this as a confirmation that we actually have more weakness than we had thought. I mean, there's a lot of angst about, is this cycle going to continue on? How much longer is it going to continue? Because everyone's been wrong about where the cycle has ended. But when I look at the data that came out today, it's more confirmation of the fact that this cycle is very late.
Ed Harrison, thank you so much for the brief. Really love it. You can see Ed Harrison, M Live, Market Live, and of course his work out on at Terminal. So it's really eclectic stuff about how Ed Harrison out of Dartmouth and Columbia, how he applies all this econobabble over to, okay, what are we going to do about it? Which is a little bit of applied economics and implied investment that has a value. I'm going to review this right now. Tell me here how I'm doing on time, guys, because I'm going to review this, and I want to be sure we try to get the whole story in. Futures tepidly weaker. S&P futures at -6, the VIX 15.46. In the yield space, it's just a jumble. I have a higher yield in the 10-year, 4.06%. 2-year comes back under 5 with some significant disinversion. The real yield back to 1.80%. What do you need to do? The acting U.S. Labor Secretary with Jonathan Farrow, Julie Su, in the next hour. Good morning. This is Bloomberg.
This was the first downside surprise on the payrolls report in more than a year. Live from New York City this morning. Good morning, good morning. With equity futures slightly negative, the countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, the Open, with Jonathan Farrow.
Coming up, the U.S. jobs report coming in soft, with global yields nearing 15-year highs and the Fed on the brink of hiking once again. We begin with the big issue, payrolls in America.
You have to, pay attention to the data.
Payrolls, jobs data,
labor market data.
Labor is the key.
Labor supply is going to be hugely important.
That employment picture is probably the linchpin that we're all looking for.
Labor market remains quite resilient. Labor markets have to soften.
We really need to see the job market start to crack.
We haven't seen anything crack yet.
The stronger the data comes in, the more aggressive the Fed ultimately needs to be.
We're still worried that the Fed needs to do more.
They're taking everything into account.
They're going to have to continue to hike until they break labor.
The Fed has to break the labor market.
If the Fed is looking to loosen the labor market, we're just really not seeing that in the data.
The employment story is still very strong.
At the end of the day, this is going to be a big concern for the Fed.
What about that ADP report? Joining us now to discuss the payrolls report, Mohammed Al-Aaron of Queen's College, Cambridge, and BlackRock's Rick Reeder. Gents, wonderful to catch up with the both of you. Mohammed, first to you. Your response to that jobs report 31 minutes ago.
Good morning, John. 3 responses, from the specific to the general. One is, despite the miss on job creation, this will not get in the way of the Fed hiking in July. It will moderate expectations as to what happens thereafter. But with the wage growth, the labor force participation, and the unemployment rate, these 3 things means it will hike in July. 2 is the craziness we're seeing in the fixed income market, where the 2-year has been all over the place, and God bless Rick for navigating this market. The craziness we're seeing there highlights not just the regime change, but importantly, the lack of a policy anchor. And then the final thing is something that's not discussed often enough, is that if you look at the details of this jobs report, it indicates that it is the most vulnerable segments of the population that are at risk right now.
God bless Rick Reeder. Rick, what's your take?
I appreciate that a lot. Listen, I agree with everything Mohammed said. It's a solid report, though. I mean, yes, it was a little softer on the headline, but the wages were up, the work week was up. And, I mean, you're operating at 3.6% unemployment rate. We just had claims data that continues to show that labor's in good shape. JOLTS data was a little bit encouraging, and that private hiring was coming down a little bit. But, boy, you're still talking about a lot of jobs open. So, anyway, I think I think you got to parse it quite finely to say it's softer. I mean, it's solid. I mean, the economy is solid and employment data is solid. And agree with Mohammed that, listen, the Fed's going to keep moving on the backside of this.
And to be clear, the bond market is of that opinion as well. Yields are climbing higher now by 2 basis points. We're back through 5% on a 2-year. Initially, off the back of the downside surprise on the headline number, yields were lower. They've popped back. You look through the rest of the report, Mohammed, to Rick's point, you've got the average hourly work week that's just a little bit longer, unemployment a little bit lower, wages coming in a little bit softer. Mohammed, where are you now? Which camp are you in on the FOMC? Are you of the opinion that there are long and variable lags to policy, there's enough in the pipeline? Or if you were on the committee, would you be pushing for more to do, more hikes?
John, it depends what anchors this committee, and you've heard me say this over and over again. If this committee is anchored by we've got to get a 2%, whatever may, and central bank policy is the only tool being used, then they're going to have to hike at least a couple more times because they're highly data dependent. If, however, they step back and have a more strategic view of the economy and recognize that we have issues on the supply side and that crushing demand to address supply issues isn't the right thing at this stage, but it means accepting a much lower trajectory or decline in the inflation rate, they would hike once and stop. But the problem, and you've heard me say this, is that when you're excessively data dependent, you'll swing all over the place. And with that, markets will swing all over the place, and then the risk of something breaking goes up.
Well, they have been in the bond market big time. Mike McKee's with us to break down this report. Mike McKee, the headline, disappointing, but beneath the surface, this is a mixed one.
It is a mixed one, but it might be, as we were talking about on surveillance a few minutes ago, a turning point. 209,000 jobs is still a very strong report. So it's not like we've fallen off a cliff here and we're well ahead of the number of jobs we need created to absorb new entrants into the labor force. And as you guys were just talking about, we're at a 3.6% unemployment rate. Hours worked went up, and average hourly earnings unchanged on the month after being revised up for May. So you have some strength in this report, but it does raise the possibility maybe that we are now slowing down to a sustainable level, and it will keep the idea of a soft landing in play. You take a look at where the jobs were and weren't. We knew housing has been very strong, new home construction very strong, construction up by 23,000, government up by 60,000. There could be a seasonal component to that, and that is probably not going to continue. And then you look at retail. Are we seeing a slowdown in retail sales? We've seen a bit of one, and so is this a precursor to what's going on? And then everybody likes to look at temporary help because that's usually seen as a sign of what's going to happen going forward with the labor market. Now I'm going to switch gears and go to inflation because that's the big number next week. This is the Cleveland Fed CPI nowcast. And as you can see, it tracks pretty well with what's happening on CPI, and it does see a big drop next week to a little over 3.5%, which would be a sign to the Fed that they are making progress. The interesting debate is going to be how much of an impact wages are having. Profits have fallen off, and there was all the talk about greedflation, but wages are still high. So are wages creating inflation? That's going to be the question for the Fed, and of course they're arguing maybe not.
Mike McKee, thank you, sir. Rick Reader, let's get into it. Payroll's behind us, CPI in front of us. We've had a disappointing read of the headline number. We've talked about the nuances around that. The rest of it is pretty solid. CPI next week, what would need to happen to stop the Fed from hiking in July?
I think it's going to be pretty hard to stop the Fed from hiking. I mean, we think it's going to be a softer number. I mean, some of the high exogenous influence you've had from used cars, shelter, shelter comes down with a lag. We think that is going to come down, and we think you'll get a softer number. I think the markets anticipate that already. But I think it'll be pretty hard unless the number was extremely soft, which is hard to believe. Listen, the Fed is, I think you got to take them at their word. They paused. We could debate, was it effective to pause or not? But boy, it would be pretty difficult given all this labor data we got that we've just received. It'd be pretty hard to take the Fed off the mission, at least for this meeting. We could debate future meetings.
Well, Mohammed, let's talk about future meetings. This is what Andrew Hollenhorst of Citi had to say this morning. Risks are rising. The Fed will once again need to deliver a more hawkish message, perhaps at Jackson Hole in late August and/or the September FOMC meeting. Mohammed, I think for a lot of us, we're less interested in July, maybe even less interested in what September might bring. It's really about whether they need to go much further than that. Never mind 25 to 50 basis points. Do you have an opinion on that yet?
So that's where the disagreement is, John. I think most people expect they will hike in July. There's one or two outliers, but for the reasons that Rick just said, they will hike in July. And this is despite, I want to stress, I also expect next week's CPI number to be quite soft. We may get very low in the threes, but look at core. Core is going to be critical because of the changing dynamics of inflation. The fact that inflation has now migrated and is well embedded in the service sector. That is the concern. As to what happens thereafter, inflation will prove sticky, core will prove sticky, and the Fed is going to have to choose. Can it live with a 3 to 4% inflation rate that is stable, or does it want to crush the economy to get to 2%? That's the choice that they're going to have to make later in the year. And that's why people are all over the place, because their expectations of the real economy is quite different. As you know, I've always thought a recession need not happen, that this economy is strong enough to avoid a recession. But a lot will depend on how the Fed plays it.
Well, to be clear, you've also suggested, Mohammed, and you've insinuated it there, that they'd have to tolerate higher inflation to make sure that recession doesn't happen. Is that still the case?
Yes, John. I don't think anybody can deny what's happening on the supply side. We're seeing significant deficiencies of aggregate supply. They're happening from the rewiring of supply chains. They're happening from the geopolitics. They're happening from the energy transition and the labor market itself. Labor force participation has been stuck, and we're not attracting more people into a hot labor market. So we have issues on the supply side, and this notion that we've got to crush demand, we've got to crush jobs to address a deficient supply side, for me, that's not good economics. We've got to address the supply side and make it more elastic.
Let's talk about a bond market that's been crushed as well. 10-year right now, 3-4%. 2-year right now, around 5%. Rick, as you look across that curve right now, what's a buy for you?
Like commercial paper. You know, yeah, we're buying. I mean, it's pretty incredible. You can buy 6-month to 1-year commercial paper. We bought some this week at 6.6% yield. Good issuer. By the way, not a fly-by net issuer. I mean, it's pretty attractive. I mean, if you can clip in CP, if you can clip 6s, and you know, you're seeing banks, you're seeing others that are and companies for working capital that are issuing there. That's pretty darn attractive. Listen, I think you still got to be a bit patient on the rest of the curve. And you know, let it do what it's going to do. I mean, to take a lot of duration risk today doesn't strike me as an awful lot of sense.
We've got to tease some more out of you than that, Rick. Are you saying there's still upside risk on that 10-year right now?
I mean, I do. I mean, you know, you look at. And by the way, you operate in the bond markets in a global framework. You know, the Bank of England is hiking, the ECB is hiking. And by the way, there's a lot of duration. DV01. There's a lot of duration that comes into those markets. You know, U.S. Treasury's got to issue a lot of debt. I mean, by the way, look at the amount of bills that are coming to market every week. It's not like we're running out of supply to purchase. So listen, I think rates can move a bit higher from here. You know, do you start wading into some places? You know, some of the credit markets I think are okay. The mortgage market I think is okay, and you know, I think it'll perform reasonably well. But I don't think there's any race. I remember we were on a couple of months ago and we were talking about, and somebody was saying we're going into a recession. You got to get into that.
Sure.
I don't know. I don't think there's a race.
We were talking about credit crunches and banking failures only a few months ago.
Right.
And look at us now. Mohammed, the UK, end of September, Liz Truss is in number 10 Downing Street. We're talking about financial instability and bond buying, more QE potentially from the Bank of England, and rates then on a 2-year gilt yield, we're through 470. Right now, they're looking at 550. Mohammed, have we walked away from the financial instability of the last 12 months a little bit too quickly? Do we need to keep an eye on that?
We do, John. I mean, what's happening in the UK is the amplification of the inflation problems all over the advanced world. Inflation that is more sticky, is higher, and the Bank of England's got to go do even more. Add to that the real economy is weak. So this is probably the most difficult policy challenge out there. And you have now the society is literally gripped by interest rate fever. Everybody's talking about mortgage rates. Everybody's talking about what's the Bank of England going to do. It's not limited to Bloomberg anymore. It's everywhere. So it's going to be really interesting as to what happens to sentiment. I think the main issue now, John, is that while we've navigated interest rate risk relatively well, notwithstanding what happened in March, but we've navigated as a whole relatively well. The big question is, do we also have to navigate credit risk? That is, I think, the big question. In the UK, the answer is more yes than anywhere else in the advanced world.
Rick, what's your response to that for the US?
I mean, listen, I think you got to be a bit careful about, as rates continue to move higher, I think you got to be a bit careful about the levered parts of the market, whether that's leveraged loans, whether obviously commercial real estate's been well established. We're going to have more pressure on the banking system. There is no question about it. You're going to continue to lift the cost of deposits. You can't build capital. So I think there's going to be, an increase of some stress in some places. But, you look at, there are also a lot of the investment grade markets termed out its debt. I mean, the housing market is, consumers have paid down their debt. So it's going to be bifurcated, but you're definitely going to have in the stress parts that are interest rate sensitive, there's definitely some credit stress that's going to continue to come.
We'll build on that in just a moment. Rick Mohammed, you're going to stick with us. Equities right now, just a bit softer on the S&P 500, negative by 0.2% going into the opening bell. Coming up, President Biden promoting his economic agenda.
I'm not here to declare victory on the economy. I'm here to say we have a plan that's turning things around quickly, but we have a lot more work to do.
The latest from Washington, D.C. up next.
Chinese technology companies, let's say Alibaba, Baidu, Tencent, they have gigantic market values and they're very prominent in China, not as prominent outside of China as obviously in China, and certainly not that prominent in the United States. TikTok, by contrast, is not in China, but it's gigantic outside of China, of the United States and everywhere. What did TikTok do that enabled a Chinese-based company, parent company at least, to do so well outside of China?
We think it's challenging to build a global company in general, but the best ones we have seen so far are ones that take very consistent global learnings and adapt them to the local countries that they are operating in. So you need to be global and local at the same time.
The share of working-age Americans in the workforce is as high as it's been in 30 years. Remember they used to say, Biden spent all this money to keep people from working? People are off the sidelines. And folks, it's no accident. It's Bidenomics in action.
President Biden promoting the impact of his economic agenda, in particular highlighting the labour market, arguing it's the outcome of his legislative accomplishments as the June top line payrolls number comes in lower than expected. Bloomberg Kelly Lyons joins us now with more. Hey, Kaylee.
Hey, John, lower than expected, and yet we still haven't gotten a statement out from the White House, but you could expect that they are still going to spin this in the positive direction, because at 209,000, that is still relatively robust payrolls growth and brings the total even further above 13 million jobs created since President Biden took office. This is something he has continually touted. Also, the unemployment rate as well. Just last night, the president was tweeting how unemployment has remained below 4% for the longest stretch in 50 years, so that ticked down to 3.6%, evidenced in the data today, likely something the president is going to flag, as well as the stronger wage growth, the idea that Americans are seeing their wages moving up to compete with the higher costs that they are facing, though, of course, in recent weeks, the president has repeatedly been trying to push the message that he is assisting in getting inflation down through things like the Inflation Reduction Act, also touting things like infrastructure packages and the CHIPS Act, of course. The difficulty for this administration, John, and for this re-election campaign of President Biden is, despite an economy and a labor market that still is looking very tight and quite robust, it is not translating into his polling. A new Economist YouGov poll came out just yesterday that showed the president has just 42% approval on his handling of the economy, 52% disapprove, and actually the average, according to Real Clear Politics polling over the course of the last month, is even lower than that at 38.7% approval. So if indeed the Fed, after looking at this data, hikes once again this month, tightens policy further, and we start to see that deterioration in the labor market taking shape later this year or into 2024, that's getting closer and closer to when voters are going to have to head to the polls and decide if they want to vote for this president again, John.
Kelly, thank you. The latest from Washington. We'll build on that with the acting Secretary of Labor, Julie Su, in about 20 minutes from now. Back with us for a final word, Mohammed Al-Arian, Rick Reeder, back with us now. Rick, you mentioned this about whether high interest rates are actually biting into this economy or not. Mohammed, Torsten Slock of Apollo wrote about this morning, why it's taken the Fed so long to slow the economy down. Pointed out a number of reasons. Here's three. High savings in the household sector, post-COVID. Went on to say, during the pandemic, high-yield investment-grade corporates extended the maturity of their loans. U.S. households have 30-year fixed mortgages. They're therefore less sensitive to Fed hikes. Mohammed, from your perspective, just how rate-sensitive is this U.S. economy?
So he's absolutely right. Initial conditions matter. And the initial conditions were such that we had strong household balance sheet and strong corporate balance sheets. So monetary policy hasn't hit. But John, we are the envy of the rest of the advanced world. I was sitting with a European politician yesterday, and he was complaining that foreign direct investment is going to the U.S., including European investment is going to the U.S. So we mustn't forget that this economy is, in relative term, outperforming many other economies. And therefore, when people live in relative space, as they do most of the time, they will come to the U.S.
Rick, does that shape your approach, your bias geographically in markets at the moment?
Yeah, by the way, I'll say one thing. I mean, I think when people talk about the Fed just keep going, if you think about where we are, most people are sitting in mortgages that they locked in at 3%, 4%. So that's not interest rate sensitive. The companies that are growing, healthcare and tech, are not big borrowers. What ends up happening is once you just keep raising interest rates, all you're doing is you're impacting the lower end of the income strata. In fact, people higher end are savers and they benefit from it, and the people that are actually hurt by it, I just don't feel like to raise interest rates. One man's opinion. Now, to your question, listen, I do think the U.S. is, particularly in equity space, the most attractive place. By the way, globally from a debt perspective, I actually think EM is interesting. Although we've been talking about it for a few months now, it's had a pretty good run. But the EM central banks got at hiking earlier, and you're seeing inflation coming down. I actually think EM is in LATAM, Mex, Brazil are actually interesting places to invest. But generally, I would say U.S. is interesting. The credit markets in Europe are the other place, so that I feel like you're getting paid for taking the risk, and we think the default paradigm will be reasonably low there. But so anyway, I would say that shapes it generally.
Well, you took us there. Let's sit on it. EM, Mohammed, that's your world, particularly with your work with Gramercy. What's the big one for you at the moment?
I think being highly selective. Rick mentioned a few places that are interesting. You've got to be highly selective, higher in quality overall, and then look for the overshoots. Look for a situation where the market goes too negative. There's certain cases right now that are trading at ridiculously low levels. But the bottom line for me is highly selective, highly differentiated, because there will be a lot of dispersion going forward.
I have to say, Rick and I want to be where you are, Mohammed. It looks very relaxing. Wooden cabins.
It is true.
No comment from this end.
Of course.
That is. Hopefully no screens on.
Thanks for being with us, Mohammed. We appreciate it. Rick Reader, to you as well, sir. Thank you on this Payrolls Friday. Just breaking down a really nuanced report, what it means for this Fed. For this Fed, it looks like a hike in July. But for a lot of us, it's what happens after that, further down the road. How do they set the stage for policy, to Mohammed's point, strategically, going forward from here beyond the September meeting? Equities right now, just a little softer going into the opening bell, about 8 minutes away. We're negative 0.2% on the S&P 500. In the bond market, yields initially much lower following the jobs report. Then they popped higher again. We're just south of 5% on a 2-year maturity. On a 10-year, we're still through 4%. Yields are higher by 4 basis points. Elsewhere in the FX market, the euro trying to gain some traction through 109, just sitting above that level at the moment at 109.09 on the euro against the US dollar. Coming up on this program, the morning calls, and later, more on that downside surprise in the payrolls report. We'll catch up with Victoria Fernandez and PGIM's Michael Collins. Looking forward to that conversation, and this one too. Judy Su, the acting Secretary of Labour, the White House response, the government's response, Washington's response to this labour market report of the last hour or so. From New York, this is Bloomberg.
I don't think we can replicate Tesla. Tesla is a unique because when they founded, and then the personality behind it, the product is beautiful, technologically very, very strong. So in many areas, Tesla is Tesla, but XPeng is XPeng. We want to focus on what we think is important for our customers. Our customer like beautifully designed vehicles, either it's large SUV or sports sedan. We believe we have a very, very appealing family look that our customers is really attracted to. They like to have user-friendly features inside the cabin that has a technology feel. It's very smart. It enables them to really utilize the vehicle that's different.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority.
It's a mixed payrolls report. It's nothing like ADP from 24 hours ago. 1 hour ago, we got the payrolls report. Headline number comes in a little bit softer. Unemployment, though, lower. Wages a bit hotter. Average working week a little bit longer. Equities a bit softer, down negative by 0.2% on the S&P and the bond market. Yields were down, but back up again. They're pretty steady now at the front end. The 2-year almost unchanged at about 4.97 after going through 5% just before the payrolls print a little bit earlier this morning. That's the price action. Let's get you some morning calls. First up, JP Morgan downgrading Commander to neutral, seeing limited upside as the next US election cycle approaches. Barclays upgrading Newmont Mining to overweight, highlighting the stock's attractive valuation and recent underperformance. And finally, Wolf Research upgrading JP Morgan to outperform, saying shares deserve a premium given the bank's favourable loan mix. That stock is up by 0.4%. Coming up, the US labour market softens in June. More on the latest payrolls report with Crossmark's Victoria Fernandez and PGIM's Mike Collins. That's next. Your opening bell just around the corner.
maybe I should go do something else. I can't do anything better than I'm already doing. I've already turned this company around. I've made a lot of money for the investors, the shareholders, and yourself. Are you happy doing this? You're going to do this for the foreseeable future?
I'm going to do it for the foreseeable future. I love what I do, and the reality is we've accomplished a lot. As you described, we've made Blackstone a lot of money. We made our shareholders a lot of money. More importantly, we've grown the business, and we've been a huge engine of opportunity. If you think about all the jobs we've created around the world, all the communities we've made better places, all the ownership groups who we've helped grow their business, and having built a world-class culture, the opportunities we've created for upward mobility for people. And this business, I would still say, is like a coiled spring coming out of COVID particularly. So I feel like we just have more to do. My job's far from done.
Today's CFOs are reshaping the C-suite. Bloomberg's Chief Future Officer shines a spotlight on these dynamic leaders. Fenway Sports Group has become a $10 billion global powerhouse. CFO Julie Swinehart tells Tom Keene how she's helping the company raise its game.
Winning's at the core of everything we do here, and the balance sheet is so important to the success of the team.
Watch Chief Future Officer Wednesday on Bloomberg.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Seconds away from the opening bound this morning. Good morning to you all. Couple of days of losses on the S&P. No big drama, but the S&P 500 yesterday, biggest one-day drop going back to late May, incidentally. Right now, futures softer by 0.2% on the S&P, on the Nasdaq down by 0.1%. All of this following a downside surprise on the payrolls report about an hour ago. There's your opening bell. Switch to the board and get to the bond market. This is what the bond market looks like now. Yields higher, initially lower. We're up by 3. Through 4% in the last 24 hours. First close above 4% on a 10-year post the collapse of SVB. Left behind that very quickly, didn't we? Let's see if that comes back on the table anytime soon. In the FX market, the euro reclaims 109.09 on that currency pair. The euro against the dollar positive by 0.2%, and crude lower, down negative by 0.4%. $71.50. About 25 seconds into this session, here's the broader market for you. We're down, lower by 0.3% on the S&P, just a bit softer on the Nasdaq. One stock to watch at the open is Meta. Twitter said to be threatening legal action following the launch of Threads. In a letter to Mark Zuckerberg posted by Semaphore, Twitter's attorney writing, Twitter demands that Meta take immediate steps to stop using any Twitter trade secrets or other highly confidential information. Abby has more. Hey, Abby.
Hey, John. Yeah, never a dull day here for big tech. And of course, in this case, it has to do with Tesla and Twitter's Elon Musk versus Mark Zuckerberg of Meta, Instagram, and now Threads. And it's Threads that's at question. On Wednesday, when the app first launched, 2 million users within 2 hours, then 5 million, 10 million, 30 million. So yesterday, Twitter sent that letter to Meta. Alex Spiro, Twitter's lawyer, known as being super aggressive, basically said that Meta has hired dozens of former Twitter employees who may have access to confidential information. They're threatening that trade secrets lawsuit, saying that they will strictly enforce its intellectual property rights, its highly confidential information. It's very difficult for this sort of a plaintiff to succeed. Ultimately, they may actually be looking for an injunction, which would also be difficult. Another question would be, because Meta responded saying that Twitter engineers are not on the Threads engineering team, would they have to prove that there's some sort of Chinese wall? So many unknowns. What we do know, John, on the day we have Meta up slightly, Twitter's up a bit more. Tesla, the proxy for Elon Musk, up 1.4% on the year. Tesla up 125%. Meta up 143%. Probably the early stages of the fight, but again, they will probably be looking for either an injunction or some sort of monetary damages. But how do you calculate the future and what it could mean? Stay tuned.
Abby, thank you. You mentioned Tesla. Let's turn to Elon Musk's other company in the news as well, providing fresh incentives for potential buyers in China. Writing the following: buyers will get 3,500 yuan in cash and a 90-day free trial of enhanced autopilot if they make the purchase via referral from another Tesla customer and take delivery within a certain period. Ed Ludlow has more. Morning, Ed.
Yeah, good morning, John. Tesla is up 1.3%. Several pieces of news. The near-term driver of the stock is news crossing the Bloomberg terminal in the last 20 minutes that Mercedes-Benz is joining Tesla's charging standard here in North America. From 2024, Mercedes-Benz customers will have access to the supercharger network via an adapter, and Mercedes, like many others in its industry, later offering an engineering fix or production fix to match that standard, while also building out their own network. The piece that Bloomberg reported overnight, in addition to what you said on China incentives, is that Tesla has started making some workforce reductions on the battery team in Shanghai, according to sources. There are 20,000 people that work in that Shanghai plant. What we're talking about is individuals on the team that take the cells from third-party suppliers and assemble them into modules and packs. One source told us that an element of this is because there is an aspect of automation that can replace some of those jobs. But this comes at a time where we are talking quite a lot about the price war, quote unquote, in China and the compromise that was reached in the last 24 hours. The third piece of news very quickly, Mizuho raising its price target on the stock to $300 from $230, maintaining a buy rating. If you're a Bloomberg Terminal user, go on ANR and just take a look on the top right-hand corner of the screen. The average 12-month analyst price target is 222.55. Tesla trading at 279 currently, and you'll see that since the news flow around other automakers joining the NACS standard charging standard, that's where the stock's really taken off. But it's taken time for the sell side to catch up in that respect. We're now kind of on an upward trajectory in terms of how the sell side see this stock going currently, John.
Ed, you made 3 points. Let's pick up on the second one. Just the cut to workers in China. Can you build on that a little bit more? Can we read into anything about demand potentially in that country, given where deliveries came in so well in the last few months?
The use of price cuts as a lever based on the latest quarterly production and delivery data indicates that did work in a market like China, where there are many more domestic players offering a wider range of battery electric models. BYD is a great example, right? Where in that country, they also sold more than 300,000 battery electric units. And if you extend that to plug-in hybrids, more than 700,000. What I've learned in speaking to sources is that it is normal in all of Tesla's facilities for them to review the structure of the organization and just make logical changes, trim teams or reallocate headcount. And we did report, according to sources, that those battery module assembly members that the jobs were removed were offered, in some cases, chances to move to other teams in the facility. And again, 20,000 people work in Shanghai, John, for Tesla, and that plant accounts for more than half of output last year. So it's kind of shuffling the deck, but it is worth tracking the minutiae of what's going on there.
Stock is up about 1%. Ed, thank you. The latest on Tesla there and Elon Musk. I want to turn to the financials going into earnings next week. Wolf Research upgrading JP Morgan to outperform, downgrading Wells Fargo to peer perform. Wells Fargo management has executed well, but shares have outperformed and valuation has converged with peers, while our JP Morgan upgrade is far from contrarian. We believe guidance will prove conservative. Shonali Basak back with us for more. Hey, Shonali.
Good morning, John. You're taking a look at Wolf Research. Look at two of the banks that are trading better than any of the banks in the system as far as the top six goes. Listen, when you take a look at Wells Fargo, Wolf Research's move here goes against the grain. 70% of analysts still say buy Wells Fargo. But what they're looking at here are the risks on the horizon, commercial real estate risk, regulatory risks. The reason the timing here is interesting also, John, is because you have Wells Fargo and JP Morgan are two of the banks that raise their dividend among the most of the big banks as well. So they're giving something back to shareholders. They are performing, but with Wells Fargo trading at about book value, you have Wolf Research now telling you maybe book value is just enough. JP Morgan's case is the bull case, and JP Morgan's case applies to other banks as well here, John. It's the idea here that capital markets, not necessarily all investment banking and trading, but the return of capital markets, IPOs, debt underwriting, will help banks like JP Morgan and Bank of America moving forward. That is the money case of the second half, according to Wolf Research.
Shonali, leading our coverage starting in about a week from now. You get some rest this weekend. Shonali, thank you. Looking ahead to JP Morgan results next week. Before we get there, of course, the CPI report. Behind us already today, earlier this morning, the payrolls report. Stocks wavering. Treasury yields near 2023 highs after a cooler than expected payrolls report at the headline. Mohammed Al-Arian weighing in earlier in the program.
despite the miss on job creation, this will not get in the way of the Fed hiking in July. It will moderate expectations as to what happens thereafter. But with the wage growth, the labor force participation, and the unemployment rate, these three things means it will hike in July.
Two of the best on this. Let's get straight to it. Crossmarks, Victoria Fernandez, PGIM's Mike Collins. Mike, first to you, buddy. Your thoughts on that payrolls report an hour ago?
Yeah, Jonathan, I think it's a really simple message consistent with our view that economic growth is moderating, labor force growth or labor growth is moderating, wage growth is moderating, but it seems to be stuck kind of in the 4+% area, which is a little problematic. That's probably 50 to 100 basis points higher than the Fed wants to see wage growth. The breadth of labor market is waning, right? You're seeing the gains really in a few sectors now, which is kind of a leading indicator of maybe weakness ahead. But there's not enough leverage in the system for a big hard landing, right? So you're going to see a moderation in growth, a moderation in inflation. The Fed is going to hike in 3 weeks from now, 19 days from now. I think that's a done deal, but the threat of a hard landing is really low here.
Is it a done deal, Victoria, from your perspective?
Yeah, I think that at the July meeting, we're definitely going to get a hike at that point. You've just heard some of the hawkish talk from the Fed, even just from the last meeting, talking about the expectations of at least 2 hikes. And so I think given July and the jobs report that we've seen, I think it is a given. The labor market is key for them because it has the average hourly earnings, and labor cost is what's keeping inflation along with rents, but it's what's keeping it sticky right now. So they're trying to figure out how can they bring those labor costs down. You have average hourly earnings up 4.4% year over year. As Mike's used the word stuck for that, then I think that's a way that the Fed is looking at it. They're stuck right now, and what can they do to improve it? Because look at some of the other elements of the labor market, Jonathan. You've got quit rates that were up in the JOLTS report yesterday. You've got longer-term averages that are coming down. Continuing claims were at a 5-month low. Yeah. So you've got elements that are telling you this is still strong and the Fed has more to do.
The work week lengthened. So let's talk about what we've got in this bond market now. 2-year just south of 5%, 493. 10-year at the moment just north of 4%. Mike Collins, how active have you been this week? Is that a buy on a 10-year at 4%?
Yeah, we, as you know, Jonathan, have been short duration here for a couple of months, really since the dust settled on the regional banking crisis, mostly in the belly of the curve, so long kind of cash and a little bit long the very back end, but that whole intermediate part of the curve is again pricing in still probably too many aggressive rate cuts too soon. So we've been short that, but with this big backup in rates, as you mentioned, I mean, the 5-year is up 100 basis points really in a couple of months. 5-year real rates are up 100 basis points. The numbers here, that 4 handle on 10-year treasuries is starting to get more appealing. We believe we're going to be in a range, say 3.25 to 4.25 on the 10-year. As you get toward that higher end of the range, you have to cover that underweight, and we've been doing that. We've been reducing our underweight really in duration.
Interesting. Mike, let's keep building on that. Mike Collins, Victoria Fernandez, they're going to stick with us. We'll work through this market. Price action, yields near 5% on a 2-year in the last 24 hours. We back away from that. Equities right now just a little bit negative. Coming up, a downside surprise in the payrolls report.
We are the envy of the rest of the advanced world. We mustn't forget that this economy is, in relative terms, outperforming many other economies.
Reaction down in Washington, up next.
July 11th, Bloomberg is live in Lithuania for the NATO Leaders Summit. support for Ukraine, expanding partnerships, broad security challenges. We're bringing you news from the meetings and what they mean for the markets.
At the summit, we'll actually make important decisions to address our two main threats, Russia's aggressive actions and our efforts to fight terrorism.
It all starts July 11th. Bloomberg, your global business authority. From the world of politics
We're not going to be relying upon countries whose values we don't share.
to the world of business.
It's all about corporate power at the end.
Balance of Power, live from Bloomberg's Washington headquarters.
We're going to be more excited what's in store for you.
How long will it take? How many years? Why don't we take this one day at a time? Good luck. Everybody has a perspective.
Every weekday at 5 p.m. Eastern Time. Join hosts Anne-Marie Hordern
It's the one area, really, of bipartisanship.
I think we're getting more of it.
That's optimistic.
and Joe Matthew.
The debt ceiling is looming. How close are we going to get to the line before you start to worry?
Alongside Kaylee
The
Langs.
door was open for regulators to do more, and that puts the Fed between a rock and a hard place.
As they deliver news
This is such an important economic issue. He's no longer trying to run away from
That really blew some minds.
Insight.
We can both invest in law enforcement and also make sure that communities feel safe in their own skin.
And analysis.
I think your audience will get this more than most.
This is not the Republican Party that you know.
It allows him to do what he did so successfully in 2020, which is run against crazy.
From and about politics' biggest power players.
This was the zombie case, and it's now more than well alive.
That's for sure. With two more potentially to come. I'm willing to have this battle.
It is vitally important. This is the intersection of Washington and Wall Street.
Bringing people directly to the decision makers
Right.
that impact your investments and your life.
Balance of Power, every weekday at 5 p.m. Eastern, only on Bloomberg, your global business authority. A lot's happening on Wall Street.
There are so many factors at play today.
It remains tight in certain parts of the economy.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insight
Crisis is too strong a word, and words like that get used a lot.
from business's most influential and instrumental.
America's economy needs a diversity of institutions. That's something that Wall Street pays a lot of attention to.
Bloomberg Wall Street Week, live tonight with replays all weekend on Bloomberg Television and Radio.
Live on Bloomberg TV and Radio, I'm Jonathan Ferro. Joining us now from Washington is Julie Su, the acting U.S. Secretary of Labor, responding to the labour market report from about an hour and 15 minutes ago. Secretary Su, fantastic to catch up with you. Just your first reaction to the payrolls report from earlier this morning, and whether we're seeing broad-based strength in this economy or something that's showing us things are slowing down.
Good morning, Jonathan. Thank you very much. This is a good jobs report. It represents steady and stable growth, which is what we want. It shows that the president's policies, Bidenomics, is working. It's combined with a 3.6% unemployment rate. Many predictions were that it would not get below 4% right after the pandemic-induced economic crisis for a long time, and these policies have defied that. And in fact, we've seen less than 4% unemployment for 17 consecutive months now, which is the longest duration since the 1960s.
We know we've got a bit of tension out there in the labour market at the moment, and you've been involved in some of that, so I want to build on some of it with you. We have a tentative agreement covering West Coast port workers. That's been an issue for a while, and you've had some involvement, so congratulations for that. We now have a new issue, so let's talk about that one, the potential for 300,000 UPS workers to go on strike. How involved are you in those discussions with the union and UPS?
Yeah, thank you, Jonathan. Thanks for mentioning the port, because those parties worked very hard for over a year and did reach a tentative agreement recently. It still has to be ratified, so the process is not over, but it demonstrates that collective bargaining works and that you can reach agreements that are, as the president often says, good for workers, where companies can profit, and that's good for the economy as a whole. And there remain other negotiations that are going on, right? That's what it means to be in an economy where workers have some power, where unions are at the table, and we are monitoring the negotiations, but trust that the parties are going to do what they need to do.
Have you spoken to UPS? Have you spoken to the union involved this week?
Yeah, I've been in touch with both parties. I've also, just in my role as acting secretary, talked to parties to these negotiations, as well as unions and employers across the economy. And so, again, I'm hopeful and know that that they're going to continue to do what they need to do, and that a fair contract is something that that everybody hopes that there can be win-wins, as we saw at the port.
Secretary Sue, I've heard that word thrown around quite a lot by this administration, this word fair. And language is important, it's meaningful. What would fair be?
Right. So this president has been very clear that fairness and equity is very important, and that we can build an economy that is fair and equitable, meaning from the bottom up and the middle out, right, where nobody gets left behind, where we invest in the middle class. Bidenomics is all about investing in America, and in particular industries like semiconductors and manufacturing and infrastructure, but also investing in American workers and also increasing competition to decrease prices. All of those things are part of what President Biden believes is fair, and what we believe this jobs report demonstrates that a strong and fair economy can be.
That's all great, but we have to define what it means. For UPS specifically, and this agreement they're going to try and strike with this union, what would a fair wage increase be? Can you put a number on it?
Well, I will say the same thing that I said when I was out at the ports talking to the parties. A fair contract is one that the members are going to ratify. So a fair contract is something that that workers choose at the end of the day. And again, that process is important for the parties to be able to negotiate, to be able to stay at the bargaining table, and to be able to resolve issues. And I do believe, and as has been shown time and time again, there are win-win solutions there.
Don't we have to be careful there, though, if we start saying things like fair is whatever the union wants?
Right. So, at the bargaining table, right, there's all kinds of issues that we have seen throughout history that when workers can bargain alongside employers who are committed to, employers who understand that the best investment they can make is an investment in their workers, there's all kinds of things that can happen when it comes to wages and working conditions and benefits. And those are the kinds of things we want for every American worker, right? We want stable work. We want a path to the middle class. We want security in retirement. We want health benefits. We want leave. Those are all things that the president has prioritized. And I think those are all elements of what it means to have a good job.
There are issues you're working on, Secretary Sue. I know that. Your nomination hasn't been progressing to take you from acting Secretary of Labor to Secretary of Labor. What's going on with that? Can you give us some information on the timeline you're hoping that this gets dealt with?
So the president has expressed great confidence in me. He's nominated me to serve as U.S. Labor Secretary. I am doing that job. The confirmation question is certainly one for the Senate, but I've also appreciated the broad support I've had from a number of senators, and we remain hopeful about confirmation. And meanwhile, I am here to do the job and do what the president asked, which is help him finish the job. And we're, again, seeing progress and continued growth, and we know we have more work to do, and I'm all in to help get that done.
Are you concerned it's holding up the department's agenda at all?
No, so the work of the department continues full steam. We are, we have enforcement work to do to ensure that every worker gets the wages that they're owed and comes home healthy and safe at the end of the day. We are laser focused on connecting employers who need workers to the good jobs that are being created in the economy, to working people who are looking for those jobs. So that's another big priority for us, and those are very important, and we will continue to do them, and I'm proud to lead the department in these efforts.
Secretary Sue, we're happy to catch up with you this morning following the payrolls report. Thanks for being with us. Julie Sue there, the acting U.S. Secretary of Labor down in Washington, D.C. Following the payrolls report from about an hour and 21 minutes ago, with us for a final thought, I'm pleased to say Victoria Fernandez, Michael Collins, still with us. Victoria, let's talk about this market and equities. Equities have absolutely ripped this year. And in fairness to those that have been optimistic about the labour market, including this administration, last year, if you'd asked us where unemployment would be, I'm not sure we'd say in and around 3.5% 12 months later, and here we are. At the start of the year, if you asked where equities would be, I'm not sure we'd say up 16% on the S&P, down to about 15, 14, whatever it is now, on the S&P 500, the Nasdaq up by close to something like 40% year to date. Victoria, what did we get so wrong and what has gone so right?
Yeah, it's an interesting observation, Jonathan, because I am one of those people, as you know, that was not as optimistic on this market. And we really thought that we would see a recession somewhere around the middle of the year. Now we look at that closer towards the end of the year, still thinking that there's these elements out there that should cause us to have a little bit of caution, whether it's money growth, whether it's inverted yield curve, the rate hikes that we've seen from central banks around the globe, all of these things. But we've had some elements come in to really support this economy. When we had the bank issues in March, we had the Fed step in and put a tremendous amount of liquidity into the market. We saw the TGA spending in the first half of the year. That was a tremendous boost to the economy as well with the liquidity component. We've had a consumer that I think has stayed stronger than what people anticipated. Another force for the economy to continue to do well. And I think you've had rates up until this last week, rates for most of this year have stayed somewhat contained. That again, or yields, I should say, not rates, but yields on treasuries contained. That's given a boost to the economy as well. I think what we've seen over the last week with yields moving higher, I mean, that 3.90 to 4% range we thought we'd be stuck in for a while, we sliced right through that this week, and we saw the market pull back. You look at gilts. Gilts yields are back up to where they were back at the end of last year, and you've seen that equity market pull back about 10%. Same thing with boons. So I think we need to look at some of the issues that are occurring that could pull the market back. But up until now, there has been quite a bit of support for the economy that I think most people thought would be on the downside by this point.
And Mike, I want to give you the final word. I've got about 30 seconds left. The final word is yours, sir.
Yeah, similar thoughts, Jonathan. I think if the markets start pricing in more of a permanence to this higher level of rates, i.e. 4-handle, intermediate term 10-year treasury yields, I think that has to put pressure on valuations of all assets, right? Last time rates were this high, equity multiples were lower. It's really tough to justify, I think, equity multiples, real estate valuations on other types of debt, if rates stay at these levels.
Mike Collins, Victoria, to the two of you, thank you. Your trading diary up next.
Crucially important, and I think we've moved from this attitude from it's an indulgence, a waste of time, almost an illness that needs a cure.
For something as universally important to human life as sleep, mysteries surrounding its necessity and utility have only just been recently uncovered.
Some of our biggest discoveries were in the 1970s or 1980s, and so it makes it a really exciting field because it seems as though we're uncovering new insights each and every day.
Some scientists are going further to find out how sleep and what happens there can be harnessed to further expand our understanding.
It's easy to memorize things. That makes you smart if you can spit back a lot of facts. But if you want to be wise, if you really want wisdom, you've got to know when and how and why to use that information. And that's what your brain figures out while you're sleeping.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question. Best question I get all night.
Bloomberg, top experts, great questions.
Here's the trading diary. The NATO summit kicking off on Tuesday. CPI data Wednesday. Jobless claims Thursday. Then on Friday, bank earnings begin. JP Morgan, Wells Fargo, Citi, all coming up. From New York, that is for me. Enjoy the weekend. Thank you for choosing Bloomberg TV. This was the countdown to the open. This is Bloomberg.
large Chinese technology companies, let's say Alibaba, Baidu, Tencent, they have gigantic market values and they're very prominent in China, not as prominent outside of China as obviously in China, and certainly not that prominent in the United States. TikTok, by contrast, is not in China, but it's gigantic outside of China, of the United States and everywhere. What did TikTok do that enabled a Chinese-based company, parent company at least, to do so well outside of China?
We think it's challenging to build a global company in general, but the best ones we have seen so far are ones that take very consistent global learnings and adapt them to the local countries that they are operating in. So you need to be global and local at the same time.
The top names in business are on Bloomberg.
For Indigo, this is a 500 planes order. That's the biggest order ever in terms of number of planes. It doesn't change the short-term perspective on ramping up the production.
All our aircraft deliveries are delayed. The supply chain that was really decimated during COVID.
It's a real challenge for all the OEMs at the moment, but we absolutely have to have those aircraft delivered on time.
Nobody covers business like Bloomberg, your global business authority.
On the David Rubenstein Show, peer-to-peer conversations, I uncover the untold stories of the world's most successful leaders. Watch Wednesdays on Bloomberg Television.
This is Bloomberg Markets with Paul Sweeney.
We got a lot of green on the screen here, but the volume is light. This is a market that's much more optimistic or bullish than maybe central bankers are. 9.5 million job openings. What are people doing? Are they just sitting in Starbucks all day?
Breaking market news and insight from Bloomberg experts.
There's still some concern out there in the market that there is room for things to deteriorate a little bit more than what they're indicating.
As small and medium-sized businesses struggle, they don't present as much competition.
What are you guys thinking about hardware, software? How should investors approach this thing called AI?
This is Bloomberg Markets with Paul Sweeney on Bloomberg Radio.
All right, everyone. I'm Madison Mills in today with the one and only John Tucker.
Hi, Madison.
Paul Sweeney. Hey, JT.
I think Paul Sweeney, because the Northeast Coast line for trains is down today.
Oh, okay. So
he's a little trouble getting in. So
all
he's
right,
going to
so
stay at the shore.
He's stuck at the shore. Terrible place to be. In the meantime, another not so great place to be is the stock market today, with stocks slipping a little bit after that hiring data remaining high enough to squash that speculation that the Fed would potentially not hike next month. We're looking about an 80% chance, 90% chance rather, of that hike when you look at what's priced in right now. We're going to continue to talk about all of that and more. But first up, I'm going to let us get a check on news and markets with Charlie Pellet.
Hi, thank you very much. And here's what's going on. Right now, we've got the 2-year 4.94% with the 10-year 4.09%. U.S. stocks are trading mixed. Jobs Friday, our coverage continues right here on Bloomberg Markets. We've got the S&P up 2 points now, little changed, up by about 0.1%. Dow Industrials down 15. That is a decline of less than 0.1%. And NASDAQ, as we wrap up a holiday-shortened trading week, up 46 points, a gain there of 0.3%. Russell 2000, though, rallying by 1% right now. Again, we have got the 2-year yielding 4.94%. Spot gold up $11 the ounce to $19.22, up 0.6%. West Texas Intermediate crude oil up 1.2%, $72.70 for a barrel of WTI. Jobs Friday, non-farm payrolls increased by 209,000, the smallest advance since the end of 2020, after downward revisions in the prior 2 months. Moments ago, we spoke with U.S. Acting Labor Secretary Julie Su, who offered up this update on those labor talks between UPS and the Teamsters.
Yeah, I've been in touch with both parties. I've also, just in my role as acting secretary, talked to parties to these negotiations, as well as unions and employers across the economy. And so, again, I'm hopeful and know that that they're going to continue to do what they need to do, and that a fair contract is something that that everybody hopes that there can be win-wins, as we saw at the port.
And you can hear more of that conversation on the Bloomberg Surveillance Podcast. You can download it wherever you get your podcasts. Shares of both UPS and rival FedEx are higher right now. We've got UPS up by 0.6%, FedEx also higher by 0.6%. Again, recapping, the Dow lower, little change, down less than 0.1%. The S&P higher, little change, up by less than 0.1%. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
All right. Thank you so much, Charlie. As always, like you said, the S&P turning a little bit higher after erasing that opening decline. We're going to talk about all the big moves today with the one and only Carmen Reineke. Is that how I pronounce your last name?
I just answered that question. Everybody has problems with your last name.
I'm so sorry.
Reineke?
It's Reineke.
Reineke.
Yes, correct. It's a tough one.
I hate that I didn't know that, because I got to sit with Carmen on the equities team for a bit, and she taught me a lot.
And you didn't know her name.
And I didn't even know her name, but we
There
talked
just
about
aren't
our
a lot
pets.
of Carmens, so.
There are a lot of Carmens, but you are the most important one because you're here with us in studio on a Friday. So thank you.
Friday, so I had my jeans on. I dressed down today, unlike you. Got my Levi's on. Carmen.
I know. I mean, it's very apropos. Levi Strauss is one of the movers that we're going to be talking about. So that's ticker LEVI. It's down about 6.5% after its latest earnings report, where it cut its full year adjusted earnings per share. And that is a forecast that missed analyst estimates. It looks like pressure in the quarter was from the U.S. wholesale business, which is what led to the lower outlook. So interesting there. Maybe, future for jeans not looking as bright. Maybe everybody's switching to their, summer linens. Who knows?
Yeah. Levi Strauss trivia. What do they do with the remnants from the manufacture of Levi jeans?
Oh, I know this.
The denim.
We did a quick take story on this years ago.
Recycle it into insulation.
No, they use it for the U.S. currency, the
There
paper.
you go.
Oh, wow.
The strength of the paper on which they print the currency is due to the fact that you have fibers from denim.
Who knew?
From
You did an incredibly fun
Today
fact.
I learned.
I'm a real hoot at cocktail bars.
I love it. And you've got the Levi's on, so you're also dressed well. You got your party pants on, John.
Yeah, right.
I love it. I love it. Okay, but Carmen, going back to this, is Levi's sort of an indicator of what we can expect with consumer discretionary stocks throughout earnings season? Is this about those wholesale numbers, like you said, or is it any sort of dent to consumer strength? Or am I just reading into it a little too much here?
I mean, I think that's a really important question. So consumer stocks are really in highlight right now, especially because we're looking at consumer weakness. Is the economy slowing down? Are people pulling back on that discretionary spending? There are a few headwinds coming in, the next couple of months. One that I'm watching at least is student loan repayments. Once they start, there are a bunch of consumer stocks that may be hit by that, just because, that's a major expense that hits people's budgets and might mean that they're spending less on these sort of discretionary items like Levi's. So I think it's a good question, and it's something that analysts and investors certainly will be watching in the coming quarters.
What is Castle Biosciences?
Yeah, this is a really interesting one. So this is up a lot. It's up 45%. And I mean, we see a lot of these moves in smaller biotech names, right? They can be very volatile, but this is jumping because a regional Medicare contractor withdrew a policy that would have stopped an insurer from covering a cancer test that it provides. So it's maybe just sort of an intermittent jump for the stock. The contractor says it's going to draft a new policy, so it's still trying to not have to pay for those cancer tests. Still, analysts this morning are saying that this is a positive sign, and they think that the insurer will have to cover the test, and even in sort of this intermittent period, there probably won't be an interruption in payment to Castle for those tests. So kind of an interesting jump there this morning.
All right, another jump this morning in a shocking twist. We've got Rivian moving further into overbought territory, punching through its 200-day moving average if you look at the relative strength index here. Carmen, talk to me about why Rivian just continues to be on a tear this year.
Yeah, so Rivian is moving this morning mostly because Wedbush analyst Dan Ives boosted his price target on the firm. He moved it to $30 from $25 and maintained his outperform rating. So he's saying that the electric vehicle maker is making a major turn towards executing on its long-term business model, and that they have solid demand for their unique lineup, and that they've fixed some of their production and supply chain issues. Rivian is another really volatile stock. We see it go up and down a lot, and lately it's been moving on strength from delivery numbers. So Tesla also had record delivery numbers that it reported earlier this week that lifted that stock. And so a lot of these kind of trade in a block, right? So Rivian, we also wrote earlier this week, was definitely a beneficiary of retail trading. As sort of trends get exciting for retail investors in the market, they sort of switch between AI and EV makers. And so this week, Rivian saw a big boost in retail investors buying into that stock and sort of getting back in on that electric vehicle trend.
And if you're talking about electric vehicles, you have to talk about the batteries and all the metals and stuff like that that go into those batteries, and that brings us to the next stock.
Yeah, so that's the second one that Dan Ives increased a price target on this morning. That's TMC, the metals company. Basically, this one looks like it should benefit from government's sort of easing regulation on demand for battery materials. So basically, it's one that mines these material nodules for batteries.
Nodules coming, yeah.
And so it should be a big beneficiary. Ives also raised his price target from to $4, from $3, which is implying that shares could nearly double. So that's a pretty bullish upgrade. He actually, I think, maintained a neutral rating on the stock, however. So. Yeah. Will be an interesting one to watch there.
A lot to watch, Carmen. Thank you so much for joining us in studio. As Paul would say, you get extra credit today. Really appreciate it. That was Carmen Reinecke from our equities team. We're going to go ahead and go over to Tom Gimbel now. He's the founder and CEO of LaSalle Network, and this is a hiring firm, so he is going to be able to give us a fantastic outlook of those jobs numbers that we got yesterday, and of course, the numbers that we got today. Tom, great to speak with you, and thanks so much for chatting with us on this Friday. Talk me through the totality of the data here and what it tells you about the jobs market. Is it the bad news that we should be listening to, or the good news?
I think an economist can spin it any way they want to. However, anytime an economy adds over 200,000 jobs, I'd say thank you. Let's move on to the next month. I mean, there's nothing here that we should be depressed about. I think what the layman needs to realize is there's really two messages. One is the economy good for me today? And number two is, what are economists and the Fed looking at for interest rates, which is a longer ball game at a higher macro level? And what this says right now is that because of 209,000 versus roughly 250,000, which is what the economists were estimating, is that the Fed won't raise interest rates again. That people think it's slowing down, which is actually an even better thing for the economy. Right. So we missed the number by a smidge. We still had over 200,000 jobs. The Fed won't raise interest rate. The party continues. Everybody's happy. But let's paint it as really sad and depressing right now.
Well, there was a time when if I could fog a mirror, I could get a job. Is that still the case?
It's not too far off from that, to be quite frank. We're looking at a situation where companies are still hiring. Obviously, we added over 200,000 jobs. And the difference is they're not hiring in bulk. So you might not be able to get a job at any company you want to, as you could have in 2021. However, there are more than enough jobs for people who are looking.
Okay, but when you look at the ADP data specifically, leisure was the biggest growth area. But leisure, I mean, you can tell me this, Tom, it feels like a little bit of a concerning area because those jobs can go away so fast. And we obviously saw that in March of 2020.
No, I disagree because it's seasonality. So compare June over June and look at the summer, and we know those are coming. So that was built into the estimate that the economists had that they've been doing this for forever. And when they predict 240,000 or 250,000, they're figuring in for the summer hospitality jobs too. This is a good report. Anything other is Chicken Little, as I say every month on this show.
But is it potentially a final gasp for air before the economy starts to slow?
No, I really don't think so, because what's going to end up, my guess is, what's the market doing right now?
Well,
with the stock market, I'm going to call it mixed.
Yeah,
S&P
it's
500,
a little unched.
pretty much unchanged.
Yeah, it's unchanged, right? So what that message sends, if it were a bad number, the market would be down. It's a number that says we're still adding jobs, and once the Fed doesn't raise rates at the next go around, this thing's going to shoot. The market's going to shoot up even more. We added over 200,000 jobs. It's funny how quickly we forget the spring of 2020. It's funny how quickly we forget 2008 and 2009. Those were bad. This is good. We got to keep things in perspective.
Tom, who has the leverage? Is that mix starting to change? Is it still the employee like, hey, you can give me a raise or else I'm going to go find another job?
No,
or is it the employer?
We've gotten away from that. The leverage is back on the employer side. And I think that's what the change is that we're seeing. And if there's a little bit of not desperation in the air, but fear around, it's people companies bringing employees back to the office, and the employees can't quit and go get another job working fully remote anymore because a lot of companies are bringing people back to the office. So my feeling is a year from now, we're not going to be talking, post-pandemic and who's working in the office and who's working not. Almost every company will be 3 days a week, if not 4 days a week a year from now.
And where are you seeing the most demand for workers?
It's always going to be in technology right now because we have this intersection right now where it's technology's growing so fast, and now we have AI, which is what .com was 20 years ago, right? 20 years ago, you put .com in your company's name, and you'd go public and you'd be worth $1 billion. Just wait until every company has it being LaSalle Network AI. Everything is going to be AI, 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 and we're going to see this be a self-fulfilling prophecy, that it's going to balloon a new market, and it's going to be the driver of jobs through AI and cybersecurity.
Go over average pay for me in the different industries that you are familiar with.
Well, I think average pay is a really interesting issue, and the reason is because it figures in salaried and hourly, and we have hourlies that have been that have rose over the past 3 years due to, number one, COVID pandemic pay, number two, social unrest, number three, municipalities wanting to with more liberal aldermen, so to speak, and mayors and officials running it. So we've seen the municipal minimum wage rate rise that used to be $10 an hour. In some cities, it's $15 to $17 an hour. And we've seen hourly factory workers and hourly warehouse workers go from $10 to $12 an hour to $18 to $20 to $25 an hour. So you have that aspect of the business, which is still healthy. But we'll see how that gets affected. It's usually the first area. The interesting thing is on the white collar jobs where people were getting counter offers from their employer when they leave for huge amounts to get them to stay, we're not seeing that as much anymore. We're seeing companies toe the line and say, we're not going to screw up our whole salary structure because the economy's good, not unbelievable.
But we're seeing also a decline, to your point, in weekly hours worked. Is that a key indicator to you of something that's to come, and is that something that you're seeing in your day-to-day?
No, I think you see a decline in weekly hours worked, decrease in the hospitality sector. And so when you've got people that are hiring in those phases, it sometimes leverages down the amount of hours worked by each employee. And so the thing that makes it good is that more people are getting jobs in that space. The thing that makes it bad is some people who are working overtime and doing things like that, it's not leveraged into the average hours. So you see a natural decline in that way. You also see more people taking time off in the summer, which lowers the average hours worked. I don't think that's as big a deal as a lot of economists do.
Can you give me an update on the gig economy? Where does that stand?
Ooh. Okay,
yeah, I think the gig economy was a gig. Nice. I think that it was something that we're seeing that people in good times, it's awesome. I don't need my boss. I can get a job whenever I want. So I'll go Uber, I'll do DoorDash, I'll be a dog walker, I'll do all these things. And that's why it didn't show into the jobs numbers. Now we see those people saying, hey, wait a second. I can't keep up with the cost of living doing that. I need to get benefits. I want to have a 401k. People start to settle in as Gen Z becomes in their 30s, right? So you have this cyclical nature, the same thing that happened with millennials, and they don't want to be doing gig economy work.
Really quickly, 30 seconds here, Tom. If Jay Powell calls you and says, what do I need to know about the jobs market that the economists aren't telling me? What are you saying?
I tell him the same thing I told him this morning when we were talking. No, I'm kidding. I would tell him keep things flat for the next cycle. Don't do a thing.
All right, well, we'll see if the market agrees with you there, Tom. Thank you so much for joining us this morning to break down that jobs data for us. That was Tom Gimbel. He is CEO at LaSalle Network. That's a hiring firm. So, John, he's got a great outlook on what's really going on the ground when it comes to hiring and wages there.
What does he pay, I wonder?
We got to ask him that next time he comes on.
Is it being polite to ask people when they come on how much they make?
We can ask them anything. This is Bloomberg. Let's get some company news now with Bloomberg's Steve Rappaport.
Good morning. It didn't take long for lawyers to get involved. Twitter is threatening to sue rival Meta over the launch of its new app Threads. Bloomberg's Jeff Bellinger reports.
Steve, in a letter to Meta CEO Mark Zuckerberg, an attorney representing Twitter accused Meta of unlawfully using the platform's trade secrets or other intellectual property by hiring Twitter employees to create a copycat app. Meta spokesperson Andy Stone disputed that claim in a Threads post, writing that no one on the Threads engineering team is a former Twitter employee. Meta created the new app as an alternative for Twitter users who are unhappy with policy changes implemented by Elon Musk. Zuckerberg says Threads amassed more than 30 million signups less than 24 hours after launch. Steve?
Thanks, Jeff. Shares of Meta currently down less than 1%. Here's a question you probably wouldn't ask during the AI boom. Has ChatGPT reached its peak? According to data firm SimilarWeb, mobile and desktop traffic on the chatbot dropped nearly 10% in June from the previous month, marking the first decline since launching in November. And Japanese pharmaceutical company Eisai has won full FDA approval for its breakthrough Alzheimer's disease drug. Leqembi does not cure Alzheimer's, but it's the first drug to slow progression of the disease affecting roughly 6 million Americans. There are two catches that came with approval: required testing for side effects and a warning label about the dangers of those side effects. Eisai shares closed 4.7% lower in Tokyo. And those are the company stories we're following this hour. I'm Steve Rappaport. This is Bloomberg.
Headlines and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 10:21 on Wall Street. We do check markets all day long at Bloomberg. We do have U.S. stocks trading mixed after hiring data remained high enough to quash speculation that the Federal Reserve will leave interest rates unchanged later this month. NASDAQ 100 index edging higher, while the blue chip benchmark, the Dow Jones Industrial Average, traded lower. Right now, we have got the S&P 500 index down by just about 1 point, the Dow lower by 39 points, while the NASDAQ Composite Index does remain higher. We've got NASDAQ up now by about 13 points. So again, recapping Jobs Friday, and we do have stocks trading mixed with the S&P now down by 2 points. I'm Charlie Pellet, and that is a Bloomberg Business Flash.
All right, thank you so much, Charlie. We're going to continue the conversation about these jobs numbers, John, because it's interesting to look at how the market is responding a little bit unchanged, the S&P dipping back and forth between the red and the green. But if you take a look at the WIRP function, which we love to talk about, that's WIRP in your terminal, we're looking at still, don't make fun of me. I'm trying to get extra credit, okay? I'm filling in today. 90% chance of a hike still.
Yeah, the July meeting, it's pretty much priced in by the markets that the Fed's going to go another quarter point. But
Yeah.
the thinking is maybe after this report, at least the wages part of it, that they're going to go again after July. So that's the betting, at least.
What would we talk about if
What's
not
the
for
reality
Fed's
on the
hiking
ground,
cycle?
though, out there?
Nice. That is exactly what we're going to talk about with our next guest. We've got Amy Glazer here. She is Senior VP of Business Operations at Adecco, joining to discuss that. Amy, great to speak with you. And as John was mentioning, you've got a great sense of what's happening with the employment landscape here. But start off with these jobs numbers that we got today on non-farm payrolls compared with yesterday. Are you thinking that jobs market is totally cooling off now, or is there some strength that we're missing out on here?
Yeah, good morning. I think we're still seeing a resilient market. 30 months of straight gains, although it may be less than forecasted from yesterday. It's still good news for the job seeker that's looking for employment out there.
As the job seeker, can I go in and demand a high salary?
I think we're still seeing that. That's where I do see a little bit of a dial back. As we're seeing folks look for new opportunities and even consider leaving their current positions, we're not seeing those exponentially increased salaries out there. So although they're moving, they may be getting a slight benefit and gain. They're not realizing the same benefits that we received months ago, despite the numbers we see today.
And we were talking with our last guest a lot about seasonality and how the summer impacts, hours worked with people taking time off and things like that. Also job increases in the leisure space. How much do you see seasonality impacting jobs data this month?
So I think this summer we're seeing it more than we have in the last couple of years. We've kind of coined it the summer of out of office. So a lot of folks during the pandemic had stockpiled their paid time off and vacation that we're really seeing them start to use this summer. So we're seeing an increase in part-time workers being brought in to supplement a lot of the vacation time that folks are actually taking.
Are workers coming into the office in droves now thinking that, oh boy, in this labor market and indications of maybe a recession ahead, that I better get my butt back to the desk?
I don't know if that's as much of the sense of why they're coming back, but a lot of my clients that I've been working with lately are seeing a return to the office. Just that sense of community and purpose and being together does tend to foster productivity, especially in that hybrid work environment. So we're seeing a lot of employers requesting that their employees return, not the full 5 days a week, as was the expectation years ago, but right now the new norm is a 2 to 3 day week in the office.
Is there a clear link between productivity and where it is you work?
So I think it varies by employer and by what they're tracking in terms of productivity. So I think some companies, based on their culture, see a strong result from that sense of community and being together. And it depends on, does your work require ideation and creativity and a lot of room to collaborate, or is it heads down, I need to put pencil to paper and really need my own private space to work? So I think the job itself really defines where that productivity level sits in terms of being in an office or sitting at home.
I know there's a lot to be said for just the serendipitous encounters. Like, I would know half the stuff I know unless I sat next to you and
John,
I
feel the same way. I learn so
No, you
much
don't.
sitting next to you every single day here at Bloomberg, where we do come into the office consistently. Amy, you're based in Jacksonville. Can you talk to me about what the return to work has looked like down in Florida as compared with, I talk to my friends here in New York, and it still totally varies across the board who's going into the office and who's staying at home. What's that looking like where you are?
Yeah, I think, down in the South and in Florida specifically, we started returning to the office a bit earlier than up north, part of it having to do with just the weather itself. So we're not seeing that it's as big of a news topic on the return to workspace, because I feel like in Florida, people returned to work a year or two ago. So I think that you're feeling the effects up north much more so than down here in the South.
I'm looking at the latest survey results from NFIB, the National Federation of Independents, the small business people. They say just over a third of small business owners said they recently raised workers' pay, which is actually the smallest share in more than 2 years. This is the June survey. Does that mirror what you're saying?
Yeah, I think it varies region by region and sector by sector. So we're seeing gains continue in more of the blue collar workspaces. They're trying to keep up with the race for talent in that area, which you're going to see, I think, continue. We'll see the blue collar space, especially as we start looking towards peak season. I know it's only the beginning of July, but we're really Christmas in July at a lot of employers, especially in the warehouse, transportation, e-commerce space. So you're going to continue to see gains in those areas, which oftentimes have a mixed bag. You've got some smaller companies as well as some big heavy hitters in that space.
Yeah, there's a really great Business Week story about how hard it's been to staff factory workers upon Biden's Bidenomics, all of the infrastructure plans and work going on right now, and it's been really hard to get workers specifically in that area. Amy, can you talk to me about where you've seen the biggest uptick in terms of job offers and what people are looking for from employees?
Yeah, so what I think I can tell you is one of the greatest trends we're seeing right now is the return of the retiree. So specifically in manufacturing, we are seeing it continues to be a challenge, as it has for years with the new automation and the need for upskilling and reskilling. But we also see, the mass exodus that occurred with retirees being a hindrance to their ability to fully realize those productivity gains. So we're seeing a resurgence and a return of retirees to the workforce, which I think is one of the greatest trends we'll see ongoing for the next 6 months, specifically in that manufacturing.
What counts as a retiree? I mean, in France, I think it's 30 years.
Good question.
In the U.S., what, 65 and over, or what?
Yeah, but it also varies by company. So you have some companies that offer retirement packages after 20 years. It really, again, varies by company within the U.S. as to what that age number looks like.
And John brought this up earlier in terms of our employees still having the power to ask for what they want when it comes to wages. But more seriously, when you're looking at the data side of things, what are the salary offerings looking like? And are you seeing a hit to that? Because when we look at the eco data, it does seem like wage inflation is kind of a non-issue anymore, that wage growth is totally slowing. Are you seeing that as well?
Yeah, I think we're seeing basically a rebalance of what was such a white-hot market in the past, that it's stabilizing more to a normal level of wage increases. So we are, again, not seeing those dramatic gains we would have seen this time 12 months ago.
Where are the jobs? I'm guessing that the demand is greatest in the services sector.
Services sector, healthcare continues to be a hot topic. Professional services. I mean, leisure and hospitality. Look, the numbers may not have been huge, but still, 20,000 plus job gains. It continues to try and get back to those pre-pandemic levels.
Yeah, so I want to ask you what we asked our last guest. I asked him if he was on the phone with Jay Powell, what he would tell him that he's seeing about the labor market that maybe is not coming up in the eco data. And he was very, very optimistic about what the jobs market is looking like. Amy, what is your headline view on what the jobs market is looking like that you would want the Fed to understand before they make their next interest rate decision?
Yeah, I think it's still a resilient market. And for the first time in U.S. history, we're seeing this subset of workers, approximately 50% of the population, that are saying, gosh, this inflation is really hurting me and I'm going to have to look for a second job. So we're going to continue to see the increase in part-time work. And part of that is due to folks that just really are concerned with their ability to continue to pay their bills given inflation. So we're still going to see a resilient economy, and we're still going to see the job seeker out there looking for ways to increase their wages.
Well, what does Adecco do? I mean, you give me your 10-second pitch.
Yeah, so we help, in a nutshell, help employees find great employers. So we're a matchmaker that really tries, our number one mission is to help, find a meaningful purpose for people through the world of work.
Well, I found my purpose.
Aw, being right here next to me, John Tucker.
Yeah, something like that.
Thank you so much for that lovely compliment, John. Amy, thank you so much for joining us. Amy is Senior VP of Business Operations at Adecco. Really appreciate you breaking down these jobs numbers for us. Continue to stick around with me and John as we have the time of our lives in studio over the next couple of hours. You're stuck with me until 1 p.m. today, so get excited.
Stuck with you.
This is Bloomberg, everyone. All right, we're going to head to D.C. now and get some world and national news with Bloomberg's Nathan Hager.
Okay, Madison, thank you. Cocaine at the White House is now getting Capitol Hill's attention. The Republican head of the House Oversight Committee, James Comer, is asking for a staff-level briefing from the head of the Secret Service about that small bag of the drug found in the West Wing last weekend. In a letter to Secret Service Director Kimberly Cheadle, Comer said the discovery is unacceptable and a shameful moment in White House history. Treasury Secretary Janet Yellen says competition with China should not be winner take all. Yellen met today with Chinese Premier Li Qiang after airing concerns about China's new metal export controls with U.S. business leaders in Beijing. We get more from Bloomberg's Jill Desis in Hong Kong.
It's really this weird situation where you can't just cut off all economic cooperation between these two economies, but at the same time, they fundamentally disagree about a lot of different issues, primarily about national security, and that's really sort of poured over into how they affect each other's trade and sort of how they, how they trust each other, or in this case, really mistrust each other.
Bloomberg's Jill Desis reports Premier Li is striking a softer tone as well. He says relations with the U.S. will eventually see a rainbow after going through wind and rain. Russia's war in Ukraine reaches the 500-day mark this weekend, and while the fighting's largely reached a stalemate, Ukraine hopes its counteroffensive will turn the tide, says NATO Secretary General Jens Stoltenberg.
For 500 days, Moscow has brought death and destruction to the heart of Europe, seeking to destroy Ukraine and divide NATO.
Jens Stoltenberg says next week's NATO Leaders Summit will bring a major new support package for Ukraine, but not membership just yet. Global news, 24 hours a day, powered by more than 2,700 journalists and analysts in over 120 countries. I'm Nathan Hager in Washington, and this is Bloomberg.
headlines and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 10:40 on Wall Street. We do check markets all day long here at Bloomberg, and right now we are looking at a down day for the Dow, the S&P, and NASDAQ. Right now, though, the Russell 2000 index of small cap shares is gaining 1.2%. S&P little change, down 4 now, drop of less than 0.1%. The Dow down 48, down 0.1%. NASDAQ lower by 1 point, little change there, also down less than 0.1%. Hiring data this morning remained high enough to quash speculation that the Fed will leave interest rates unchanged later this month. We've got the 10-year at 4.02%, but the 2-year 4.89%. Spot gold up $21 the ounce, now higher by 1.1%. Gold $19.32 the ounce, while West Texas Intermediate crude is up 1.5%, $72.86 a barrel. America's economy added the fewest jobs in almost 3 years in June, and with that story, here's Bloomberg's Vinny Del Giudice.
Chalk up 209,000 jobs, a respectable gain by and large, but also the smallest since December 2020. Perhaps the labor market is moderating after more than a year of Federal Reserve interest rate hikes. Don't count the Fed out, though. Unemployment is near a half-century low, dipping to 3.9%, and wage growth picked up. Vinny Del Giudice, Bloomberg Radio.
And again, the 2-year 4.89%, the 10-year 4.02%. A labor board judge has ruled that Starbucks violated federal labor law when it shut down a unionized store in Ithaca, New York. Starbucks shares, they're lower now by less than 0.1%. Again, recapping, we're looking at a mixed market. NASDAQ just turning around, up by 1 point, but the S&P does remain little change, down 2 points now, down less than 0.1%. I'm Charlie Pellet. That is a Bloomberg Business Flash.
Madison, do you know who Charlie Pellet is?
Oh my God, the voice of the New York City subway.
Do it for us, Charlie.
Stand clear of the closing doors, please. But we've been there, done that. Let's focus on markets. Let's focus on what matters to Bloomberg listeners.
It's my favorite thing, though, and it's always such a good reminder to think about you, Charlie.
Like when you take transit, it's like Charlie never leaves
you.
He
never leaves your side.
You're very kind to say that.
You've got the best recommendations, by the way, of things to do in New York. But having said that, we are going to get to markets, as you said, Charlie Pellet, because the trade is looking a little mixed today. We've got volume down by 30% on the 30-day average. If you look at the AVAT function for the S&P, we were easing some of those declines earlier today, and now it's looking like we're back in the red for the S&P. NASDAQ relatively unchanged. So we're going to talk about what to make of the day's trade with Ben Emmons. He is the principal senior portfolio manager and head of fixed income and macro at New Edge Wealth. Got a laundry list of previous work in the finance industry that we're going to talk to him about. Ben, thanks for being in studio with us. Help me make sense of what's going on in markets today. How are they digesting the data here?
Still digesting, Madison, but I think it's about, the ADP number took a lot of the gas out of the markets, right? Because that was a real surprise. So as this headline from non-farm payrolls comes in a little softer, you get a sort of muted reaction, but the reaction is the same as yesterday. Higher yields, a little bit lower stocks, because the market's trying to digest that this is a job market that doesn't really cool off. If anything, it just really underlines that the Fed has to pull forward here. It has to probably hike maybe more than 2 times because of the resiliency of the economy. There's too much strength underneath, and this report also didn't show any significant weakness in any area. So I think markets are looking at we're going to have to start factoring in a higher terminal rate that may be beyond what the Fed is factoring it in for the end of the year.
A little history. One of the former Fed chairman, Paul Volcker, used to carry in his breast pocket a readout of the latest labor agreements, wage agreements with the unions, presumably. How sticky are wages right now? Because that seems to be the key for all of us who follow interest rates.
Yeah, the average hourly earnings at 4.4% year on year. That was another, I think, sign of that. If you have labor being this strong, consistent job gains, you're going to get higher wages. And every wage tracker from the Atlanta Fed shows an upward momentum. The ones that stand out to me are construction and leisure. That's where I think the biggest wage gains are happening. maybe less of a unionized area than if you think about UPS as an example, right, of what's happening there. But to that point of Volcker, if you're getting like consistent gains of labor and wages pick up, yeah, there is some level of let's say prices drive to higher wages and vice versa. So it is happening in the economy, not the same as in the 70s, but it's definitely a trend of higher wages.
I'll go back to my question. Is that sticky? Is that going to remain?
Yeah. It looks like it's sticky because if you think of the core PCE core services, PCE X housing, you plot that against those wage trackers from the Atlanta Fed, it's exactly the same trend, almost identical, just on top of each other. That looks like very sticky to me.
How sticky then? Okay, I've been dying to ask this question, John. You're going to love this. On a scale of peanut butter to super glue, how sticky?
Oh, not super glue. I don't. That's an interesting comparison. That probably is not, because it is a competitive labor market. So I do think that if you get layoffs, so you get like some adjustment of wages in certain areas, it's just more stickier in terms of the demand for labor is sticky. That's what drives up wages, I think. That's the issue. The Commerce Department put out a report about a month ago highlighting all the labor shortages across the economy. There's a lot of it still there. That keeps those wages like peanut butter.
Okay, well, well, there you go. You do a great job, though, Ben, of looking at this from a global perspective. And when you look at the inflation picture in the UK, it makes me glad that I'm in the US, even though inflation here is pretty bleak for me when I'm being a consumer outside of the desk here. Talk to me about to what extent the inflation picture in the UK and the credit tightening we're seeing there could impact what the Fed has to do here in the States.
Yeah, there's a bit of that. That's the idea of butterfly effect, right?
Yeah.
Like, the UK, I think, is more at risk of that wage price spiral. Partly it is a more unionized economy, but it's showing the signs of it. And the UK obviously is really suffering from the supply shock in Europe, the food supply shock. That was compounded by the Brexit. That's now really showing up in their data.
Sure.
And there, the Bank of England didn't go so far as the Fed did with a number of rate hikes really quickly after one another, like large rate hikes. And this is why the market there is pricing in 6.5% of a bank rate. That's 100 basis points more than where the Fed is projected at. And I think the food price inflation is where they're struggling. They can't really cool that off because of the Brexit effect. That's really the key issue.
Does the market now believe the Fed?
They do, John. I mean, it has actually been that way for a while. It sounds odd, but that transitory discussion where the Fed apparently lost so much credibility, the bond market early on has said like, well, Fed, you started raising rates, you're going to get your inflation back to 2% over time. That's what the inflation-linked bond market has been very consistent in. And that's, I think, where we currently are today. It hasn't really changed, even though you're getting these good payroll numbers, and you're seeing continuing strength in the economy. There's another side of it that the energy markets have really cooled off from last year, and commodity markets too, so that helps. I mean, that's partly that calculation in these inflation expectations. But I do think that the market has been at the side of the Fed saying, you're going to succeed in this mission. You're going to bring that inflation rate down. It may take a number of years, but you're going to get it.
All right, the obligatory questions. July, that it? 25 basis points again. What happens after that? Is it a higher rate regime 6 months from now? You got 45 seconds.
Yeah, so July, that's now, of course, confirmed by this data with CPI next week, so that probably is going to fully cement it to 100% probability. It will remain data dependent. That's how the market is trying to price it. So the September and November meetings are all still in play, but the probabilities do show that you likely have another rate hike. So the Fed will match its median forecast, plus the probability of a 6% rate in November has nudged up a little bit to about 10%. So let's keep an eye on that, because that is not impossible to see a 6% rate.
Yeah, and it seems like if you're listening to Jay Powell, he's just going to continue to look at the totality of the data when deciding what he is going to do next. Ben Emmons, thank you so much for joining us. As always, great to see you in studio with us as well. That was Ben Emmons, Principal Senior Portfolio Manager and Head of Fixed Income at New Edge Wealth, joining to talk about those jobs numbers and, of course, what the Fed is going to do next, our favorite question here at Bloomberg. Taking a look at the markets really quickly here. Again, just kind of digesting digesting that jobs data. A little bit of red, a little bit of green. Not a lot of changes here. This is Bloomberg. We're going to get some company news with Bloomberg's own Steve Rappaport.
A breakthrough drug to treat Alzheimer's disease gets the green light for the U.S. market. Bloomberg's Lisa Mateo reports.
The FDA has granted full approval for the Alzheimer's drug Leqembi, clearing the way for Medicare and other insurance plans to begin covering the treatment. It's not a cure, but it's the first medicine that's been shown to slow the progress of the disease. The drug, which is made by Japanese pharma company Eisai, is priced at about $26,500 a year. Steve?
Lisa, investors were a bit discouraged by the FDA's conditions for approval, required testing for side effects, and warning labels about the dangers of those side effects. Shares of Eisai closed 4.7% lower in Tokyo. A judge rules Starbucks violated federal labor law when it shut down a unionized store in New York. More on that from Bloomberg's Kimberly Adams.
A National Labor Relations Board judge concluded Starbucks shut down the store near Cornell University, in large part to discourage unionization efforts in Ithaca and elsewhere. All 3 corporate-run cafes in Ithaca voted to organize. Starbucks decided to close those locations, prompting the union to denounce the move as retaliation. The coffee chain argued the closures were justified, saying the Ithaca stores had numerous absences and high turnover. Starbucks plans to appeal the ruling. Kimberly Adams, Bloomberg Radio.
Thanks, Kimberly. Starbucks stock is currently down less than 0.25%. And Twitter has reportedly threatened to sue Meta Platforms over the launch of its new Thread app. An attorney for Twitter accused Meta of unlawful use of its trade secrets and intellectual property to create what he calls a copycat app. Those are the company stories we're following this hour. I'm Steve Rappaport. This is Bloomberg.
You're listening to Bloomberg Markets with Paul Sweeney on Bloomberg Radio.
All right, everyone. I'm Madison Mills in today with John Tucker, covering everything you need to know about today's trade. Markets still definitely digesting some of that jobs data from this morning. It's a little too soon to breathe easy following that ADP report from yesterday, but definitely some good news when it comes to jobs numbers today. NASDAQ is back in the green, but only by 0.2%. S&P basically unchanged, and the Dow is in the red a little bit there. Having said that, we are now going to get some company news with World and National with Nancy Lyons. Nathan Hager. I'm sorry, Nathan.
It's okay, Madison.
You combine Nathan and Nancy, you get Nancy Hager.
There you
get
go.
Amy Morris. At any rate, the White House has taken the jobs numbers in more than stride. Bidenomics in action is how President Biden described the June jobs report in a statement. 209,000 non-farm payrolls added in the month of June, and the unemployment rate ticking down to 3.6. Acting Labor Secretary Julie Su is echoing that positive message.
It represents steady and stable growth, which is what we want. It shows that the president's policies, Bidenomics, is working.
Acting Labor Secretary Julie Su spoke earlier on Bloomberg Radio and television. These latest numbers did come in a bit weaker than expected, but President Biden in his statement says the economy's created more jobs in the last 2.5 years than any other president's 4-year term. And the Bidenomics message this afternoon is going to turn to rising health care costs. Bloomberg's Jody Schneider reports on an event the president's going to hold this afternoon.
He's going to be announcing steps his administration is taking to help lower health care costs, including targeting of so-called junk insurance plans and surprise medical bills, sort of this effort to rein in high prices for consumers as health care has gone up.
And Bloomberg's Jody Schneider reports the White House has been focusing more on hidden fees to show voters that the president is working on fighting inflation. Some breaking news in New York City. 6 people are facing charges in an alleged fraud scheme tied to straw poll donations to Mayor Eric Adams' campaign. In the indictment, Manhattan District Attorney Alvin Bragg says the suspects illegally structured contributions to maximize additional money from the New York City Matching Funds program. Mayor Adams is not accused of any wrongdoing in this indictment, but so far no comment from the Adams campaign. Only its second full day online already, Meta's new Threads app is getting some Capitol Hill attention. The number 2 ranking Democrat in the U.S. Senate, Dick Durbin, says alternatives to Twitter are a good thing, but in his words, Mark Zuckerberg still has an obligation to keep this platform safe. Senator Durbin made those comments on Threads, later reposted it on Twitter, saying, "We'll be watching closely." Global news, 24 hours a day, powered by more than 2,700 journalists and analysts in over 120 countries. I'm Nathan Hager in Washington. This is Bloomberg, Madison and Tucker. I still feel weird calling you John.
Combine that, what do you get? Never
It's a
mind.
little bit of a crazy day here, Nathan. Thank you
It's
so much.
Friday, though.
It's Friday, though. And John, you flagged such a fun story. Tell us about it.
Yeah, we were talking to the employment folks earlier in the session, and one of the questions we put to them is, it's like remote work, is that still a thing? Well, there are career coaches out there getting up to $3,000 a pop, advising people, job seekers, how to find a fully remote job. And apparently they're getting so many applications, they're absolutely overwhelmed. So it tells me people still want to work from home.
You know what it
or
tells
remotely.
me? We did it wrong. Why did we not go into career coaching, John? We could be doing that right now.
Well, I'll do it
instead
right
of this
now.
incredibly
What is it
fun.
you're looking for in a career, Madison?
What is your conversation
That'll
going
be
to look like at your
$3,000,
mid-year
please.
about work from home? Yeah, really interesting story from our Future of Work team.
But it's also a reflection of the fact that, employers now may have the upper hand
Yes.
as things kind of slow down. Like, oh, you want to
Wanna
remotely work?
remote?
Forget
you
it.
can work for a different company that's not ours. That seems to be the call here when it comes to jobs and employment. Really great story, John. Thanks so much for flagging it. Stick with us here. We're going to keep covering markets for us. More markets coverage starts right now.
This is Bloomberg Markets with Paul Sweeney.
We got a lot of green on the screen here, but the volume is light. This is a market that's much more optimistic or bullish than maybe central bankers are. 9.5 million job openings. What are people doing? Are they just sitting in Starbucks all day?
Breaking market news and insight from Bloomberg experts.
There's still some concern out there in the market that there is room for things to deteriorate a little bit more than what they're indicating.
As small and medium-sized businesses struggle, they don't present as much competition.
What are you guys thinking about hardware, software? How should investors approach this thing called AI?
This is Bloomberg Markets with Paul Sweeney on Bloomberg Radio.
Happy Friday, everyone. I'm Madison Mills here with John Tucker in for Paul Sweeney, who is out at the shore today. Seeing a little bit more green on your screen here. The NASDAQ up by almost 0.2%. The S&P basically unchanged. The Dow is still in the red here for us. We're going to continue to cover all of the big market moves for you here on our show. But first off, we're going to get a check on the news you need to know with Charlie Pellet.
Very much, and here's what's going on. Indeed, a mixed market right now. The S&P 500, NASDAQ 100, both on track to end the week lower. After data this morning showed a still resilient labor market, but one that was less robust than implied by yesterday's private payrolls report out of ADP. So where does this morning's report leave the Federal Reserve? Ben Emmons is Senior Portfolio Manager at New Edge Wealth, and he was interviewed moments ago right here on Bloomberg Markets.
This is a job market that doesn't really cool off. If anything, it just really underlines that the Fed has to pull forward here. It has to probably hike maybe more than 2 times because of the resiliency of the economy. You know, there's too much strength underneath, and you know, this report also didn't show any significant weakness in any area. So I think markets are looking at like, we're going to have to start factoring in a higher terminal rate that may be beyond what the Fed is factoring in for the end of the year.
And you can hear more of that conversation on the Bloomberg Tapes podcast. You can download it wherever you get your podcasts. 10-year yield right now, 4.02%, but the 2-year, 4.90%. We've got the S&P higher by 1 point. Choppy session. The Dow down 40 right now. Drop there of 0.1%. NASDAQ up 31. A gain there of 0.2%. Bitcoin up 0.3%. 30,394 on Bitcoin. Spot gold up $23 the ounce to $19.34, up 1.2%. And crude, West Texas Intermediate up 1.7%, $73.04 a barrel. Levi Strauss shares, they are down now by about 6%. Levi lowering its guidance for the full year, citing weakness in its wholesale business and increasingly price-sensitive shoppers. Recapping, S&P little changed, up 2 points. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right. Thank you so much, Charlie. We are going to continue to discuss some of those numbers that you just mentioned with our very own Bloomberg Equities leader, Jess Metton, here with us in studio to discuss